It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here's your morning rundown. Buckle up for big tech. Earnings are due out this week for some of the biggest names in the S&P 500. Investors are keeping an eye out for enterprise software and advertising, expected to stabilize thanks to resilient client spending. But how big of a mention will AI get? Also in focus for investors, elevated bond yields. The 10-year yield is still right around that 5% level. Strong tech earnings could pump some optimism into an otherwise worried market.
And second up, energy's big bet. Chevron acquired a medium-sized rival, Hess, in an all-stock deal valued at $53 billion. Chevron's acquisition is the latest consolidation move in the energy industry, on the heels of Exxon's purchase of Pioneer Natural Resources. Oil giants seem confident on the future of fossil fuels amid policymakers' push for clean energy. This morning, diplomatic efforts in Gaza have eased oil prices off of some of their highs.
And trouble for Apple? Well, the tech giant supplier Foxconn facing investigations from Chinese officials. This is according to reports from state-run media. Now, the probe comes weeks after the company's founder announced his bid for Taiwan's presidency. Tensions have been high between the two nations for years now, though Taiwanese companies that operate on mainland China have largely been left alone.
Well, let's get to our morning driver here this morning. We could be set for a manic Monday with the 10-year Treasury yield still flirting with 5% levels. It surpassed that level for the first time since 2007 on Thursday of last week. According to Mizzou host Peter Chatwell, that's a psychological level as much as anything. Even so, elevated yields don't tend to be great news for growth stocks. And with tech earnings hitting this week, there's lots to digest. Some of our top markets voices see headwinds for stocks into year end, but highlight different issues on the landscape.
And RBC's Lori Calvasina saying that perhaps the biggest problem the U.S. equity market faces is the recent surge in bond yields. And over at Morgan Stanley, Mike Wilson saying that the profit forecasts are too high, meaning that the odds of a year-end rally in U.S. stocks are fading. And JP Morgan focusing on the greenback. A strategist there led by Mislav Mateshka expect the dollar to remain strong within the next 3 to 6 months. So breaking all this down, what exactly this means for investors. And this is great. The reason why we're highlighting these three reports is because it really points out the issues that investors have right now with the market. When it comes to the yields that we've seen, the massive rise, the 10-year right around 5%, briefly right above 5% earlier today, although it's pulling back just a bit. And then you have earnings results so far, which investors have been pretty tough critic of, even if you're beating expectations, not necessarily enough for the market this day and age. And then also the strong dollar, what that means for multinational companies. Clearly a headwind. We heard that from a number of consumer staple stocks that reported last week, exactly how that's going to potentially complicate the landscape for those companies within the next several months. And then what all this means for investors, right, at this point, with most of that focus being on the massive run-up that we've seen in yields.
Yeah, as much as there's been different themes that have played out over the course of the earnings seasons this year, this calendar year, whether it's AI or whether that's even the restructuring that took place earlier on and some of the battles up against activist campaigns, or even more recently now, resiliency in the previous earnings season. I think this earnings season, what we've continued to hear is one tone of cost discipline, but then additionally here, where you're going to see a potential pinch here for economic growth impacting companies, and where there's a tempering of expectations. It's almost kind of a common denominator that we've seen in some instances across the earnings season spectrum over the course of this year. One of the outlooks that I point to actually is one that we didn't hear from this morning, but came out last week, BlackRock's Q4 outlook here, talking about potential waning excess consumer savings, the lagged effects of the Fed's rate hiking campaign, pinching economic growth and making it harder for companies to grow earnings in the near term. That's certainly going to get the eye of investors, especially if they were optimistic coming into the fourth quarter here, especially given the fact that this is typically when U.S. stocks post their best returns in that final quarter of the year here. So the yield environment, but then additionally here, where the Fed continues to shift or at least communicate their tenor, that's going to have a larger impact for where those earnings in the near term, where that growth stays locked in or where that starts to take a hit.
Yeah, exactly. And digging into the note out from Lori Calvasina here from RBC, reiterating their year-end target for the S&P of 4250. Lots of focus on that 4200 level, just exactly what that means. But again, the year-end target of 4250. And she's saying basically that the downside risks have grown, that the outlook has become cloudier, and they don't think that the pause that we've seen in that S&P rally that they called called for back in August is done just yet. So what does this mean for investors? That's a big question right now. They're at least saying Lori's position that large cap growth is over-owned and overvalued. She also makes the point that the growth trade, which we'll get a look at here with some of these tech earnings that are on deck over the next week or two, and then also the small cap trade, unlikely to regain their footing until that recent surge in bond yields comes to an end. So we know that that has certainly been a massive headwind for a number of these stocks, and also a headwind for investors right now trying to figure out how to best position their portfolio going in to the end of the year. All right, well, stock futures pulling back this morning as investors look towards econ data and big tech earnings. We will be getting a number of readings on the economy this week, but the big focal point is going to be the first estimate of third quarter GDP and the Fed's favorite inflation gauge, PCE. So as the Fed continues to drive home that rates will likely need to stay higher for longer, any good news for the economy has sent jitters through the markets as of late. And then for earnings, big tech results on deck. The hype around AI has been the big driver for the sector so far this year. And analysts, well, they expect that trend to continue. So here with more on how investors can best navigate the week ahead and the months ahead, we want to bring in Brad McMillan. He is Commonwealth Financial Network Chief Investment Officer. Brad, it's good to see you. Lots to unpack there. Clearly a heavy week in terms of econ data and also for earnings reports. But let's start with the move that we're seeing in the yield. That was the big news out this morning, just that brief move above 5% in the 10-year. How are you looking at that from a strategist standpoint?
Well, you're certainly right. Moving above 5% is a major barrier. We haven't been there since before the financial crisis, and it's a big round number. It's a big round number. So people are going to get scared. From a little bit more factual standpoint, we notice that stock valuations tend to be positively correlated with yields up to about 5% and then negative thereafter. So there's a real reason to start thinking this is going to have an impact. But at the same time, when you look at valuations, almost all of the S&P 500 stocks are still fairly reasonably valued. The exception are the big seven. So when you look at that from a valuation, from a yield standpoint, the risk isn't nearly as great as people might think.
What are the typical characteristics, Brad, of a high yield economy or some of the larger impacts?
Well, I want to give you a couple of different angles on this because we focused a lot on the negatives here. And when we talk about high yields, we're talking about mortgage rates. That's hurting the housing market. Okay, that's a negative. We're talking about the ability of companies to refinance debt. That's a negative. But on the other hand, you have, and most of the homeowners now have mortgages that are at low rates. They still have spending money. They're not affected by the higher rates yet. So there's no impact there. You look at people who have fixed income investments. They have more money. They can spend more. So it goes both ways. My personal take is this is going to end up being positive. We move back to a normal rate environment. I think the positives from the savers are going to overwhelm the negatives from the refinancing aspects.
Brad, what's been your takeaway from earnings season so far? 73% of the companies that have reported better than expected profits. That's just below that 5-year average. We'll certainly get a better look at the tech sector this coming week with the number of the Magnificent Seven stocks, which people have loved to call it here over the next couple of days. But what do you, in terms of the takeaway that we've seen so far, what does that then signal just about consumer behavior? What it signals about how sensitive some consumers are to higher rates, to inflation, and then how that's going to trickle down into some of these performances that we could expect to see over the coming quarters?
Let's take a step back, Sean, and kind of in a macro way to look at it. Everyone's been talking for a recession. Everyone says things are slowing down. The jobs numbers aren't saying that. Consumer spending isn't saying that. Even consumer confidence is not saying that. So for all the death of the economy has been overpredicted for a long time, and I don't see that changing. Now, that said, what does that mean for earnings? People are still spending money. You look at the third quarter economic growth, that's expected to come in very strong. So are earnings more likely to outperform or underperform? Well, we know from history they're likely to outperform, and that's exactly what we're seeing. So I think there's upside potential for earnings. And I think the valuation pressure, as I said, is not nearly as bad as it might be. So I still see some upside into year end.
What is the theme that as companies start to give their outlooks for 2024, and we've seen so many things kind of jump to the top of the list of concerns for many CEOs at publicly traded companies, none more so than geopolitical tensions, at least according to KPMG's most recent CEO survey here. When you think about the top things that these CEOs are going to be forecasting going into next year, what's the theme that you expect to prevail?
I think right now, trade and geopolitics is what's affecting most large companies. When you look at the deglobalization trend, when you look at relations between China and the rest of the world, because that's the big one, I think you certainly have that vulnerability. And then when you look at the Middle East, you also have an energy vulnerability, and that could have a systemic effect. So I think those are the two biggest issues CEOs are going to be concerned with. But again, I think what they're trying to do is they're trying to highlight all of the risks, and very appropriately so. But even as they highlight them, they're working to mitigate them. And I think that'll end up being the big story for 2024.
Brad, we got to go. Do you have a top pick going into 2024?
I like energy a lot. We have deals going on. We have the potential for growth. We have a managed supply structure. That's not a bad place to be if you're an investor.
Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thanks so much for taking the time here to kick off the week with us.
Thank you, Brad.
You got it. Well, another big deal in the energy space. Chevron has reached an agreement to buy rival Hess in a $53 billion all-stock deal, a sign of further consolidation in the energy industry. Yahoo Finance's Inez Ferre joins us with the details. Inez, big consolidation activity, energy here. What do we know about the details here so far?
And so that consolidation continues, Brad. That's right. This deal, as you mentioned, that's valued at $171 per share for Hess. Now, remember that Hess just recently reached an all-time high of around $167 a share. The deal is expected to close in the first half of next year. But the big asset, the big prize here, according to Peter McNally of Third Bridge, is Guyana. And Guyana is a country that is next to Venezuela. It's in South America. It is one of the newest oil producers. Oil was discovered there less than 10 years ago. And that is one of the most important assets inside of Hess's portfolio. So when Chevron is acquiring Hess, it is doing it in part, a big part, because of Guyana, because production there is expected to increase to more than 1 million barrels of oil a day by 2026. The bottom line is what you see with this consolidation, and what you've also seen with ExxonMobil saying it's going to be acquiring Pioneer for $60 billion, is the boost in production via mergers in concentrated assets. So in the case of ExxonMobil, that recent merger that was announced, that is for the Permian Basin, for ExxonMobil to optimize its drilling, to double its footprint in the Permian Basin. And look, Pioneer CEO Scott Sheffield in a recent earnings call said it best, that companies are going to be running out of inventory in the years to come, and you are going to see extreme consolidation. And that is exactly what we are seeing right now. We're seeing these super majors that are gobbling up these other companies to boost their production.
Inez, what do you think is behind the strategy to do this? Because like you just said, with the Exxon deal that we got earlier this month, and now with this deal from Chevron, with oil, big oil doubling down on fossil fuel investments, and doing this at a time when the U.S. is certainly trying to pivot and go green. So what do you think is behind maybe some of these strategy plays that we're seeing from big oil giants?
Yeah, so they are doing this via mergers because for a while it was seen that, okay, look, we're going green, the country is going green, so why invest in drilling new if you're going to be going into these new technologies, these green technologies? But the bottom line is that oil and gas is going to continue to be a major part of the energy mix going forward, even as the U.S. goes green, because you still need fossil fuels to mine. You still need fossil fuels to build factories for electric vehicles. You still need this. And as we're seeing with the commodity right now, oil at around $90 a barrel for Brent, you're watching the industry that's sort of doubling down on fossil fuels for some time to come, because this green energy is taking longer, and it is going to be more expensive. Investing in green energy is very expensive, especially now with the labor costs, with the cost of materials. So the strategy is to sort of double down on these fossil fuel assets, because you're going to need them in the decade to come, even as the country goes green.
All right, Ines, thanks so much for breaking that down for us here. We have just about 15 minutes until the opening bell, getting a quick look at some of the movement that we're seeing across the market here, Brad. When it comes to the 5% yield on the 10-year, it's putting some pressure across the board.
Yeah, absolutely. So let's take a look at broad strokes here out of the gate. I've got the Wi-Fi Interactive loaded up for all of the folks here at home. And we're taking a look at the major averages first and foremost to start things off. The Dow Jones Industrial Average, you're seeing that futures move, at least as of right now, moving to the downside here. Now come back to some of these 5-year, 10-year, and 30-year yields here, as they've been in focus as well. But then just focusing in on futures, since I mentioned that a moment ago, Dow futures down 0.5%. Nasdaq futures, or Nasdaq 100 right now, down by about 0.4%. And then the S&P 500 futures, you're seeing that lower by about 0.4% as well. Coming briefly back to yields as of right now, just to see where we're sitting coming into the start of today's trading activity. You've got a good look here at the 5-year, the 10-year, and the 30-year. That 5-year sitting just below about 10 basis points off of 5%, and then about 3 basis points off of 5%. You're seeing the 10-year as well. I want to get to some of the sectors that we've been watching. We mentioned two big plays here that you're going to want to be keeping your eye on here. First and foremost, let's talk a little bit about energy, because that is going to be in focus here, especially off of that big deal, Chevron. And let's add on the pre-market move that we're seeing here just very briefly here, give you that extended hours look. That is going to be the bottom figure that you're seeing, which is typical for the company that's making the acquisition to have this move lower. That's just what's taking place with Chevron. Shares of CVX down by about 2.5% on the announcement of that deal with Hess. But then additionally, taking a look across the larger energy space, you saw us end on a down note across the board last week. We'll see exactly where there's a little bit of bounce back that could be seen here. Looks like that's in Shell and then some other small players as well. But also got to talk about some of those big tech names in the mega cap landscape. You've got the Nasdaq 100, a good view of that as we start off a new trading week. Taking a look at some of those players that are going to be watched closely as they report earnings over the course of this week. Microsoft, let's start there. Flat, just barely to the upside here as we get closer to the start of trading here. One of the only green spots that we're seeing among that mega cap consortium. But then additionally here, taking a look at Amazon, you're seeing that down right now to start off, or as we get closer to the start of trading. We're still about 13 minutes off from that 9:30 marker here in New York City, where lower by about 0.8% there for right now. And then just briefly, for those of you who might have been watching some Netflix and chilling over the weekend, whatever you were doing, here's a look at something else other than what you were watching or on Netflix over the weekend or one of the other streaming platforms. Who knows? I watched a couple scary movies. I've been on a 25 days of Halloween kick in our household.
Wow.
Yeah, I know.
Which ones did you watch?
It's taking a lot of effort. Shoot, I couldn't tell you. I fall asleep on a lot of movies. Like I started
I
movie,
know that.
movie
Yeah, I was
watches me.
gonna say, use the term you watched a lot of Halloween scary movies lightly here. You gotta fully disclose. You're normally asleep within the first 5 to 10 minutes, right?
Yeah, typically. Yeah. So when they
big
say
rewatcher.
when they say, "Are you still watching?" I'm like, you know me. Come on now. Anyway, all your markets action straight ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. All right, let's take a look at shares of Foxconn. The Taiwan-based company is facing tax and land investigations by China. That's according to the Global Times. Foxconn and its subsidiaries across China are subject to tax audits and on-site investigations into land use. For more on this and much more, we've got Yahoo Tech editor Dan Howley. He's here with us. Dan, great to see you in studio.
I'm here, I'm rocking and rolling. And yeah, I mean, this is basically an issue with Taiwan as well as Apple in general. Not just Apple though, but a broad swath of the tech industry uses Foxconn as its manufacturer. And so I think one of the issues here to point out is Taiwan's going into an election. There's going to be issues along the lines of what that means for Foxconn itself, whether or not they'll be able to get along with this.
Dan, we're going to fix some audio real quick here, but I mean, the story around Foxconn is huge as we continue to think about the ability to bring capacity on in different areas of the world. Of course, there were contracts that they were trying to use to be able to break ground here in the U.S., bring more of that capacity online. I believe we've got the audio fixed here, Dan. So let's run this back from the top here, because when we think about the considerations of this company in China and the land use investigations that are moving forward, what do we know thus far?
Yeah, so like I was saying, and this has to do more with Taiwan's politics than, you think about Foxconn, you immediately think of Apple. It doesn't have to do with Apple per se, but it does have to do with upcoming elections there in Taiwan. And so obviously Foxconn being a Taiwanese company, China not exactly being excited about them having democratic elections. So this is kind of seen as a political maneuver on China's part. It was announced in a state newspaper. So there you kind of go. And so I think the issue is to talk about, though, as far as Apple and other tech companies go, because it's not just Apple's manufacturer, though they are one of Apple's largest partners, is what does this mean for companies that use Foxconn? How does this impact them? Will they see any drop in the ability to produce products? And I think at this point we really don't know. But if you look at what companies are increasingly doing around Foxconn, around China rather, is trying to get out of that area, or at least spread out their manufacturing. For so long, they were in China and they're beholden to China. They have to work with China as far as local laws. And so now they're trying to expand out of there into India, Vietnam, anywhere that you can think, mostly in Southeast Asia, to say, look, we don't want to only be in China. And they learned this lesson the hard way during COVID when there were those strict lockdowns. And Apple got jammed up when it came to being able to produce the iPhone as well as Macs. Then we saw the implications for that on their revenue. And so this is just kind of adding to that conversation of, how quickly can these companies start to build out their presence elsewhere?
So Dan, how quickly, though, when we're talking about the timeline of this, right? If we are seeing more headwinds, more risks associated here with China and companies being so reliant on China for manufacturing, when they are looking elsewhere, yes, some companies have already taken that initiative, but in terms of how long it's going to take to move away, do we have any idea? Is that a year's story? Is that a decade-long story? I mean, can you put that in context a little bit?
Yeah, I mean, it's definitely a long time. This isn't something where they can just be like, it's not like putting up a Wendy's, which, takes a little bit of time, I guess. But it's going to take years and years and years. And that's because they rely so much on the manufacturing in China. And they have some in India, they have some in other areas, but it's not nearly as much as they have in China. And so they're going to have to continue to rely on that and ensure that they're able to put out as many products as possible. I mean, an iPhone sells, millions and millions of units each year. So the manufacturing capability is necessary in China. It's going to take a while to actually get that built up, though, elsewhere.
Yeah, certainly. Well, year-to-date gains we're looking at for Apple up 33%, a lot riding on the iPhone sales this current quarter. We know it's so important here for the tech giant. But then, of course, the manufacturing side of things, what that looks like for Apple going forward. Another critical issue here for investors. All right, Hallie, thanks so much. Let's get to another big mover today, and that is Pinterest. Shares to the upside here. Stifel upgrading the company from buy to to buy from hold, and also increasing their price target to $32 a share. Now, the firm saying that they are expecting its growth to accelerate and that there is room to grow internationally. We know a lot of the focus on Pinterest has been the growth story. They have been, I guess the street has been underwhelmed with its most recent earnings report. We certainly saw a slide of following the last earnings results that we got here in the beginning of August, on August 1st, when they reported results. But in terms of what that future growth looks like, a lot of it is the global monthly active users, which did increase just about 8% on a year-over-year basis last quarter to 465 million. But what that growth trajectory looks like going forward, that is critical here for the stock moving forward. I mean, it has been an extremely volatile year for Pinterest shares. When you take a look at that longer-term chart, you can certainly see that volatility play out. But at least for Stifel, the analyst there, Mark Kelly, saying that digital advertising checks, they've largely been positive so far, and he sees that room for improvement, mostly outside of that domestic growth internationally here in terms of where that opportunity is to expand its user base.
Yeah, you really got to break out your passport for this call here, and especially considering where it's focused on some of those global regions, as you were mentioning. Just to put some figures on that average revenue per user, if you were to take a look at some of their most recent earnings results here, and take a look at that ARPU figure here, where that actually moved lower by about 1% year over year on a global metric. However, where there's opportunity is literally what they call this rest of the world category. There they saw growth of about 20%. So even though the US and Canada, that only grew 2%, and even though Europe only grew 6%, it's really that rest of the world area that they're going to kind of lean into. And it'd be a larger question of where, especially when you think about the opportunities that could potentially present themselves even in the Asia Pacific region, where this company could find some favorability. Of course, we're coming up into the big holiday shopping season where everybody who's got some type of or is looking for some type of inspiration online. Perhaps Pinterest is where you start that pin board. I don't know. I've got a shipping container home pin board of my own that I've been tracking since 2012. I haven't really taken any moves there. Financing terms are just not good right now. But at the end of the day, it really comes back to where people are finding inspiration, where they can make this platform more shoppable, and where advertisers can see themselves running more conversion campaigns on Pinterest.
Yeah, you mentioned that 20% growth for the rest of the world there in its most recent report for average revenue per user. But just to put that in more plain terms here for everyone, their average revenue per user for the rest of the world was 12 cents. Comparing that to what they've seen from the US and Canada, the most recent quarter, that was $5.92. Even compared to Europe, the average there about 91 cents per user. So a massive opportunity here in terms of room for growth when you compare that 12 cents per user to $5.92 here in the US and in Canada. How they close that gap and how quickly they're able to scale that part of the business. Clearly a focal point here for users, but there is some optimism out there on the street just in terms of under the new CEO, Bill Reddy, what he is able to do in terms of moving the company forward. Certainly they have rolled out a number of opportunities or in terms of focal points of what they want to do in order to turn around that business. Year to date, the gains are just below 7%, but we have seen a steady rise off the lows that we saw earlier this year.
Absolutely.
Well, we are just about 8 seconds here as we count down to the opening bell on Wall Street. Certainly lots of movement here ahead of the open. When you take a look at some of the focal points here going forward, we're going to be focusing on the econ data that's out later this week, a number of big earnings reports here from the tech giants. But in terms of the movement in the market that we're seeing today, a lot of the downward pressure across the major averages is because of that March higher that we're seeing in yields, the 10-year yield right around that 5% level. Briefly moving past that 5% level, the first time that we've seen that in just about 16 years. So that's putting broader pressure on equities today, Brad.
Yeah, you really love to start off your day with some confetti here. Why not? That's what we got at the Nasdaq market site just below us as we heard the pulsing of the floor, at least that we're sitting on and they are standing on. Ultimately, taking a look at the U.S. markets and where we open up as we start off a new trading week. And as we're rounding out, my goodness, we're rounding out October. I guess next week will be the official end of October, and Halloween comes with that. But anyway, taking a look at some spooky sites here to start off the day. Dow Jones Industrial Average, that's down by about 0.4%. S&P 500, you're seeing that in the red as well by about 0.4%. And the Nasdaq Composite tech-heavy average, you're seeing that down by about 0.4%. We'll round that off too. Let's go back to the Wi-Fi Interactive, why don't we? You know we love to do it. Let's take a look at the 11 S&P 500 sectors. Got them loaded up here for you on your screen. We're in red across the board right now. So ultimately pulling up the caboose, the deepest decliner. You've got XLU, utilities sector, that's down by about 1.7% here. Also, you've got XLB, some of those materials also not looking good. Nothing's really looking good on the sector. So we won't stay here, won't dilly-dally for long. But industrials found a way to creep barely into the green. Creep, 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 as Luther Vandross would say. Anyway, Nasdaq Composite, tech-heavy average. Let's take a look at that. Tech shares going to be in focus over the course of this week, especially as we get deeper into earnings season. But taking a look at some of those companies that are going to be reporting, not looking great. However, Microsoft is up by about 0.4%. Amazon starts off the week, though, down here, at least early in today's trading activity. You're seeing that down by about 0.6%, and also going to be in focus here as we move on throughout the week. Meta, it's really interesting. I can't wait to try out some of those Ray-Ban Metas, and this is the first time that I've actually thought about that just a little bit more. I don't know, maybe for holiday season or whenever they drop. I'm not sure if they're out yet. But anyway, Meta shares, they start off the day up by about 0.5%, we'll call it right now. And then also, let's just go back to see how some of those energy names are opening up here to start off the day. You've got Chevron, of course, off of that big deal that we mentioned earlier. That's down by about 3%. Don't be alarmed. It's typical for an activity that we do see when a company is making an acquisition. That's exactly what's playing out right now. However, Shell, that's up here to start off the day. That's up by about 0.4% here. All right. Well, we got some other movers to get to here, if that wasn't enough for you. Roche shares, they're also on the move here today. This comes after the Swiss healthcare giant announced it's acquiring Telavant from Roivant Sciences and Pfizer for over $7 billion. Telavant has the rights to develop, manufacture, and commercialize a new inflammatory bowel disease drug. Yeah, gonna need that. All right, well, that's down by about 0.5% right now for the company as they're making this acquisition. But this is a big deal that came across for Roivant, a company, or Roche rather, a company that's also just reported earnings as of last week as well.
Yeah, it's a big deal here. It's actually their largest deal that they have made since back in 2014. You talk about their therapies here, the treatments that they're gaining here with this deal. It's certainly a move to shore up the pipeline that we have seen for experimental medicines and exactly the role that Roche sees itself playing in that move going forward. They have been under pressure now for some time to improve and add medicines within that pipeline that they will be able to capitalize and commercialize off of because their exposure there to the COVID-19 pandemic, the products that were used during the pandemic to treat coronavirus, to treat COVID-19, certainly that has been rapidly dwindling. So they need to expand their medicine base, their experimental medicines in order to make up for some of that loss of revenue here going forward. In terms of why this makes a lot of sense for Roche, Roche's head of the pharmaceutical unit saying that from the perspective of wanting to go out there and find the best possible science, I think this is absolutely the kind of deal you can expect us to do more of. So signaling there that they are not done in terms of their acquisitions here moving forward. They see that as an important and also a very smart strategic play for Roche going forward, separating their business from some of the other pharma rivals out there. So certainly two names to keep on your radar moving forward in today's trading action. We also want to take a look at Textainer shares. They are on the move. The marine cargo company announcing that Stonepeak, a U.S. infrastructure investor, is going to take them private. That deal is expected to close in the first quarter of 2024. You're looking at a move of just over 40%. Now Stonepeak Partners agreeing to buy this company for just over $7 billion, $7.4 billion. Textainer shareholders are going to receive $50 per share in cash, with the total value of the common shares equaling just about $2.1 billion. Now, Textainer forming a critical link in the global trade. That was according to a senior manager director there from Stonepeak, saying that the business is underpinned by high quality assets and also a contracted cash flows that provide that provide substantial downside protection and resilient through cycle performance. So they're seeing it as a smart play moving forward. Again, when you take a look at the price being paid, that explains the massive move that we're seeing in shares today, up just over 43%. So we'll see what happens with Textainer moving forward under the new ownership of Stonepeak Partners.
Yeah, a company that went public back in 2007 at about $16.50 a share. It's been a storied time span for Textainer as a publicly traded company, but they will no longer have the duty of reporting to us on a quarterly basis. So, mazel.
All right. We keep right here on Yahoo Finance. We've got all your market action live from the Nasdaq market site. Stay tuned. We'll be right back. From Jamie Dimon to Elon Musk, business heavyweights have a lot to say on the state of the economy, and investors may want to listen up. Yahoo Finance's executive editor, Brian Sazi, joins us now. This is sponsored by Tasty Trade. Saz, you wrote about it in the morning brief this morning on Yahoo Finance. Some stark warnings that we're already hearing this earnings season from executives.
And these warnings, Sean and Brad, are starting to pick up. When I hear Elon Musk hop on an earnings call and I think just say, hey, market goers, we need to be more concerned about higher interest rates. Why? Because I'm seeing it real time in my business. People may not be willing to spend $700, $800, $900, or in some cases $1,500 a month at these higher rates to own a Tesla vehicle. This comes on the heels of course, Jamie Dimon saying this is one of the most dangerous times he is seeing in the world. I talked to American Express CEO Stephen Squeri after earnings on Friday. Optimistic as always for Stephen, but I think did voice a little concern about the state of the consumer. You put all these things together, and you're starting to, I think, better understand why you're seeing this nervousness in the markets. There is more going underneath the surface. They're just saying yields are near 5%, stocks are going to sell off. Consumers are slowing down a little bit, and this all comes before the holiday shopping season picks off. There are more concerns underneath the hood.
We've seen a lot of relief rallies in certain pockets of the market over the course of the year, especially if companies are successful at perhaps couching some expectations. Is that what's at play once again, or is this something that's far different calculus for CEOs?
There are, I think, just deep structural changes is happening in the market right now. When you see yields go to these levels, you have interest rates, let's say on a 72-month to finance a car approaching 9%. You have more 30-year mortgage rates near highs people haven't seen in a decade plus. These are real challenging things that consumers, average households, are going to have to deal with, and they're dealing with in real time. And then, oh yeah, you still have inflation. I know we look at all these inflation readings coming in, but you have inflation still at very high levels. Put this together, and I think you just have a market that has been unwilling to price some of these risks in. And I think that's what you're seeing right now, real-time adjustments by Mr. Market trying to figure out what are all these concerns, what do all these headwinds mean for consumers, then by extension, what does it mean for corporate earnings in 2024?
And when you talk about corporate earnings, big tech is going to be in focus this week, right? We've already seen a look at a number of the larger banks. We got a good look at some of the consumer staple plays last week. But when it comes to big tech, Saz, how much do you think is riding on the results that we're going to be getting out over the next several weeks, given the fact that obviously they were the huge driver in the markets for at least the first 6-7 months of the year?
Everything. These are the biggest companies in the world in terms of market cap. So if Apple comes up here and warns that it is in fact seeing a China slowdown, which we have been hearing increasingly about in the recent weeks, that's a concern. Google doesn't meet its guidance because of higher costs and higher interest rates to fund its various lines of business. That's a concern. Microsoft, that is the one name, I think, out of all the tech earnings that we're going to hear from this week. That could be the upside surprise based on people that I've been talking to. A lot of momentum behind AI, various AI initiatives, momentum behind Office. And then I think you are looking at what does a re-rated Microsoft look like in the world where it now owns Activision Blizzard. And I think the street, just looking at the earnings estimates for Microsoft, has not properly adjusted for that. I would expect those estimates on Microsoft to go way up and way up very soon.
You know, it'll be interesting too, especially from the tech perspective, because there's been such an acquire to grow or consideration of, all right, how do we build this out internally? And the acquisition or the investment strategy into AI so that they're not missing that wave, that has been prominent. That's been the headline over the course of this year. So you got to wonder, in a yield environment like this, where even some of those smaller companies might be harder to get, it might be harder for them to get capital, and that access to capital becomes more difficult, do they eventually announce or have to move towards some type of acquisition or sale to some of these larger companies too?
Well, I'm going to ask all these questions, as are you, at the Yahoo Finance Invest Conference at November 7th, New York City, Moonlight Studios. In terms of AI, I'm actually very excited. Alexander Garfinkel speaking to Runway's co-founder and CEO. That is going to be an interesting conversation. Also, you have companies that are outside of that. We're talking to a lot of media CEOs. I believe you're speaking to Jeff Zucker.
Yeah.
Media, you look at Paramount shares, really are trading at 52-week lows. That is a company right on the cusp of just seeing just, I think, more troubles because of the higher cost of debt, a lot of debt positions. But again, we'll get into all those topics. Yahoo Finance Invest, New York City, November 7th. So jazzed up, really, really, really excited. You guys are both on stage with some very big people, just very big.
Be a lot of fun.
Yeah.
Very informative for our audience too, obviously.
Exciting.
Those big names.
Salas, thanks for joining us in studio today.
Yahoo Finance Invest, November 7th. So excited.
What day?
Yep, November 7th.
Awesome.
All day, every day.
We'll see you there. Well, we are live from the Nasdaq here this morning, and everyone, we got to shift gears as the criminal fraud trial against FTX crypto exchange founder Sam Bankman-Fried is heading into its final stages following nearly 20 witnesses for the prosecution. That means it's nearly time for Bankman-Fried to decide if he will take the stand. Yahoo Finance's Alexis Keenan joins us with the details. Hey, Alexis, thanks so much for joining us here this morning. Help us break this down just a little bit more.
Sure. Hi, guys. So the Manhattan trial, it will resume on Thursday, and that's when the government is expected to rest its case. And it's by then that the former crypto king will have to decide and make that fateful decision whether to testify in his own defense or say nothing in response to his handpicked executives at FTX and its sister hedge fund Alameda, who all took the stand and said they helped Bankman-Fried commit multiple felonies. Their story is that FTX customer funds were spent on speculative crypto trading, also luxury real estate and political donations. Now, criminal defense experts, they caution that very few criminal defendants actually take the stand, and that's because of the high risks of cross-examination. On one hand, testifying would allow Bankman-Fried to say he didn't intend to put customer funds in jeopardy. He could also even try to put blame on his former colleagues, saying that it was their fault that they did not secure the funds. But in doing so, he's also going to have to explain, as CEO of FTX, why he risked $8 billion. And he knew about that as of June 2022. Now, legal experts also say that it's more typical that a defendant will not testify when they think the government has not met its burden to prove the case beyond a reasonable doubt. Now, so far, these witnesses, they've been damning against Bankman-Fried. It's through their version of the story, though. So on the other hand, you have Bankman-Fried's company policy to use self-deleting messaging apps. So a lot less documentation, a lot evidentiary documents for the prosecution to work with in this case, though there were a lot of preserved, a limited number, I should say, of preserved messaging apps, Google Documents, and other things that the witnesses were able to point to. But remember, Bankman-Fried also made that very unusual choice as FTX was imploding to post on Twitter, to talk to media and interviews, all of that coming back to haunt him at this trial. But we should learn at least by Thursday whether he is going to make the decision to actually speak on his own behalf. But that's his take, guys.
All right, Alexis, thanks so much for that. It's certainly something that we will be keeping a close eye on. All right, well, we've got all your market action ahead live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq. Well, markets are on edge as tensions escalate in the Middle East. Fears of the conflict spreading to neighboring nations, driving the S&P 500 last week and into this morning. We're looking at more pressure across the board here in the early trading day. Well, the geopolitical threats prompting Ed Yardeni to raise the odds of a recession before the end of 2024 to 35% from 30% at the beginning of the month. The odds were at just around 25%. With more on growing Middle East tension, here is Yahoo Finance's Rick Newman. And Rick, we've been talking about it now for the last couple of weeks, but certainly this does pose just another risk to the markets moving forward.
Right, and I pulled out Ed Yardeni's note there as representative of what seemed to be broad concerns on Wall Street and in the investor community about how this war might get worse and directly affect markets. I think it's safe to say, for the time being, what's happening between Israel and Hamas in Gaza and elsewhere in Israel really not hitting markets. If you just look at the oil price as a proxy for that, I mean, it's around $87, $88 right now, not really higher than it was when Hamas first attacked Israel on October 7th. But the concern, of course, is that we could be one spark away from something that gets a lot worse. And you've seen some stories in the press recently about the White House concern that Israel may actually do some kind of preemptive strike against Hezbollah in Lebanon, which is north of Israel. Gaza's in the south. That could create a much worse situation than we have now. And of course, the linchpin of all of this is Iran, which sponsors Hezbollah in Lebanon. It sponsors Hamas. And it is quite happy to see Israel get into this conflagration, whether in the south, in the north, everywhere else. So there's just a lot of worries about this. I mean, at this point, I think we're talking about a fear premium. It's a fear that is driving things right now. But the fear, of course, is that if this gets any worse, we could have oil prices spiking well above $100 per barrel, and who knows what else? U.S. involvement in an actual shooting war. Let's hope it doesn't happen. I mean, one of the points Ed Yardeni does make is that Middle East wars often generate buying opportunities because things do tend to settle down. But the question is, before we get to the settle down point, how much worse is this going to get?
I mean, Rick, when we think about some of where the recession risk has already been present, and then on top of that, we layer on the geopolitical conflict that has come to the top of the minds for many CEOs that we're hearing from over the course of this earnings season. Even if that timeline gets pulled forward here, has that changed how going into 2024, especially given the fact that you're tracking politics as well, where politicians are going to be either talking more about the economic situation as people are expected to continue to do what they always do and vote with their dollars?
Right. So that recession prediction by Ed Yardeni is a 12-month prediction. He's talking about by the end of 2024. Every time you hear recession prediction, you have to be skeptical and keep in mind there have been dozens and probably hundreds of recession predictions during the last 2 years, right, none of which have come true. I mean, we're probably going to get GDP growth in the third quarter later this week in the 5% range. I mean, that is remarkable. And in the current quarter, maybe it's around 2%, which frankly is just fine. Even if it's 1%, it's still growth, and that would be slowing down. So I guess you always have to think that we could have a recession in 12 months. Again, I think the thing to keep in mind is if the situation in the Middle East basically stays the way it is right now, I think markets are okay. Let's just keep in mind what markets are worried about, and to some extent pricing in, is that this gets a lot worse, that it sends oil prices skyrocketing, and that American forces actually get involved in a shooting war. So there's no guarantee that's going to happen. There is a stability case. You could look at the other, but fears are obviously just a lot higher of something going terribly wrong than they were 3 weeks ago.
All right, great context as always, Rick. Appreciate the time this morning. Rick Newman,
Yahoo
Finance's own. See ya. All your markets action ahead, live from the Nasdaq market site, everyone. Stay tuned. You're watching Yahoo Finance.
When it comes to the race for AI chips, NVIDIA is dominating the market. But now some of their biggest customers, Tesla, Microsoft, and Amazon, are working to reduce their dependence on the company's chips. NVIDIA rivals AMD and Intel are also developing their own AI capabilities. The goal? To chip away at NVIDIA's lead and claim a chunk of the market for themselves. NVIDIA is on top of the tech world and leading the AI revolution thanks to prescient investments it made in AI processing years before anyone was talking about ChatGPT. And that's translated into some huge wins for the company and its investors. But NVIDIA is just one company. And as the AI explosion continues to reverberate across the tech industry, major players ranging from Amazon and OpenAI to Microsoft and Meta find themselves competing for all of the chips NVIDIA can pump out. And it's simply not enough. Now a new race between tech's biggest players is heating up, in which they're building their own AI chips that will give them the ability to outwit each other without having to rely so heavily on NVIDIA's chips. This race is setting up to be the next big battlefield in the tech industry. But NVIDIA isn't resting on its laurels. The company is already working on a version of its next generation superchip, the GH200, which it says offers improved technology and will be available through manufacturing partners later next year. NVIDIA's current most advanced chip, the H100, sits in a 10.5-inch graphics card, which is then bundled together into a server rack alongside dozens of other H100 cards to create one massive computer. The GH200, meanwhile, combines an H100 chip with an ARM CPU and more memory. In its most recent quarter, NVIDIA's revenue jumped 101% to $13.51 billion, with data center revenue, the segment that includes AI sales, up a stunning 171% versus the year prior. According to Reuters, some estimates put NVIDIA's AI market share at as much as 80%. The reason? It's not only the developers, it's not only the processors it develops that required to power AI applications, but the complex software necessary to run them as well. And the company is increasingly creating the kind of foundational models that tech firms use to develop AI software, ensuring that its customers stick around well into the future. But with demand surging and chips selling for tens of thousands of dollars, companies like Amazon, Google, Meta, Microsoft, Tesla, and others are increasingly leaning on their own specialized chips to power their AI ambitions, called ASICs, or Applied Specific Integrated Circuits. ASICs, unlike GPUs, are designed specifically for a specific task, such as AI processing. And while they're expensive to develop, they can provide benefits in the long run by using less power and giving companies greater control over the hardware they use to power their AI software. According to the information, Microsoft has been working on its own AI chip since 2019, and in May, Meta announced it was developing its own AI hardware. Google, in August, debuted its latest AI infrastructure, and Tesla is building a supercomputer based on its own chips. And while each of those companies will still need to get their hands on NVIDIA chips for now, building their own hardware could cut into the graphics giant's lead in the long run. NVIDIA is also keeping an eye on its traditional competitors, AMD and Intel. Both companies are working to try to catch up with NVIDIA in the AI race, rolling out their own chips and software designed to better combat the category leader. That said, the AI chip race is still in its early stages. And while NVIDIA is a mile ahead, it will need to keep innovating if it intends to hold on to that lead. And with products like its GH200 superchip on the horizon, it looks prepared to do just that. With the AI chip race not slowing down anytime soon, then, how should investors think and invest in this boom? Here to dive into it are Technalysis researchers Bob O'Donnell and Deepwater Asset Management's Doug Clinton. Bob, thanks for joining us. Doug, thanks for joining us. I just want to jump in real quick, Bob, with a question about what these kind of investments mean that NVIDIA is making mean for the likes of the Microsofts, the Metas, the Googles. You know, as they start to build out these technologies or continue to build out these technologies, what does it mean for those companies as they try to get their hands on these chips now?
Well, Dan, look, you laid it out very nicely. And obviously, NVIDIA has a big lead over the competition out there. And I think, we're going to see AMD and Intel, as you pointed out, and Qualcomm even to some degree battling here. And then the custom work that you're going to see, I think you're going to see primarily as a supplement. I think a lot of these companies obviously continue to use NVIDIA and some of these other companies, but they want to supplement that with their own work. The trick is, it's easy. Well, it's not easy. It's hard to do one chip, but it's super hard to do a whole line of chips. And that will be the interesting story as we look ahead long term. How do these companies maintain the semiconductor work? Because that's the tricky part that's a lot of companies have really struggled with.
Yeah, Doug, I want to get your thoughts on this too. We're looking at Microsoft talking about, or the information reporting that Microsoft's working on its own chip since 2019. That's a long time. I mean, we're in 2023 now, so that's not exactly coming out quickly. How long does it take these companies to develop? And if they're caught flat-footed, like some of them have been, what does that mean for those that are just starting to develop their own chips now?
It means they're pretty far behind. I mean, it can take 4, 5, 6, 7 years to really develop a chip and ultimately get it into a position where you can use it in a data center. And not only that, when you're talking about a company like Microsoft, when you're talking about Google with TPUs, I mean, we've heard through some of our industry contacts that Google has probably invested upwards of $5, maybe even $10 billion in terms of developing its TPU chips. And so it's a massive investment of time and capital that you have to think about over a very long time span with these companies. For us, the bottom line is whether companies are developing their own chips or they're relying on an AMD or an NVIDIA, we sort of think all roads lead back to TSM because they're really the only company in the world that can do the advanced manufacturing no matter what company is building the chip.
Well, when it comes to something like, a Meta, a Google, an Amazon, they're working on these chips now. How do they stack up what they currently have to offer? How do they stack up to what NVIDIA has to offer, Bob?
Well, I mean, the one company that you didn't mention was Amazon, and Amazon has had chips specifically for AI. They have the Inferentia for inferencing, the Trainium chip that they've developed for training AI. So, I think AWS is where in particular they're deploying this stuff within Amazon. But Amazon, I think, has got a pretty decent head start. I think the other companies, you're going to see them come along. And again, I think you're going to see, as Doug pointed out, it's a huge challenge. It's a multi-year challenge for them to get out there. So we may not see the real benefits of these things for several years. And there's going to be a lot of opportunities, again, for the big existing players to establish themselves. One of the other big things that's critical is not only the manufacturing of the chip, but it's also the software around the chip. One of the reasons NVIDIA has done so well is because of all the work they did around CUDA, which for AI and CUDA to work with all the foundation models, the AI frameworks, and all the other things that are necessary to build the software that you need. And we're seeing other companies starting to catch up, but that takes an equally long time, and it's a different kind of effort. So it's that combination of manufacturing, chip design, as well as software, and then blending all three of those together that's really necessary to be successful in this area.
Yeah, Doug, I want to get your thoughts real quick on the kind of stocks that people should be looking at here. What kind of companies do you think people should be investing in or looking to invest in? What kind of sleeper hits do you think there might be?
We mentioned TSM just a minute ago. I think if you're trying to find not necessarily a sleeper, but probably the safest, most likely company to benefit from this AI revolution on the chip side, I actually would argue it's TSM, not even NVIDIA, because obviously, they make NVIDIA chips as well, but kind of to the point of the conversation, no matter who wins, no matter what chips are being used in these data centers to handle AI workloads, they're probably going to be made by TSM. And so that's a company that we own in our Frontier Tech strategy. We have an index there that powers the Loop ETF. I think the other one, and it's kind of a wild card, but it's kind of not. We've talked a little bit about AMD. NVIDIA does have 85, even 90% market share for AI compute right now. I don't think anybody thinks that's going to change. And I think to Bob's point around the software, CUDA is an incredibly powerful development environment. They have a great community around it. But I think there is a wild card. There's a world in 3, 4, 5 years where AMD could take meaningful market share. They've got good, solid products. And if they do that, I don't think that's priced in the stock in any way. And so that could be one where a lot's priced into NVIDIA right now, not as much as priced into AMD in our opinion. So that could be your wild card.
Well, Bob, what happened to Intel and AMD here, right? I mean, these are supposed to be two of the largest chip makers in the world. You know, NVIDIA, they were supposed to be a gaming company. Why are they now the company that everybody can't stop talking about? Why are they benefiting so hugely from this revolution? And Intel and AMD are now also ran. Shouldn't they have been doing this as well?
Well, and they have been, but look, you made a point at the very beginning of your piece that I think is critical. Jensen Huang, the CEO of NVIDIA, made a couple of bets a long time ago around the early AI stuff, and it turns out that a lot of the work that they did there really benefited. This is what is causing this explosion. So there was some good, intelligent go that helped. But there's a couple of things out there. Like Doug said, AMD has got a lot of opportunity there. They've been building up their software. Their chips on a pure performance basis are actually getting reasonably close to NVIDIA. And there are some arguments on certain levels that, at certain price points, they're doing better in terms of price per value than the software. Their software story is coming along. I think Intel's another interesting thing. And while I agree with Doug that TSMC obviously has been the manufacturing hub, look, here's the wild card I'll throw out there is if Intel gets their manufacturing together, their foundry services, and they start winning clients, like maybe they start building NVIDIA chips down the road. There have been rumors of that for a while now. Something like that could also be interesting. And of course, Intel is doing their own work and their own efforts. And the other thing to bear in mind, one I'll just throw out there, when we think about AI, everybody focuses on the GPU and those sort of chips, but turns out a lot of that stuff is still done with the CPU, which of course is where Intel's winning. And you see, even with Grace Hopper, as you pointed out with NVIDIA, they've got an ARM CPU. It's that combination of CPU, GPU, and what is called an NPU together that we're seeing powering these AI workloads. So I think you're going to see different companies play in different ways, but obviously, all the buzz and excitement continues to be NVIDIA, and it's going to be for a while because of how hard it is to overcome, as I said, software plus chip design altogether.
All right, Bob O'Donnell and Doug Clinton, thank you guys so much for joining us. All your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communicopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Big tech earnings are on deck this week. We will hear from Microsoft, Google, Meta, and Amazon. They're among the names set to release their results. It'll be a big test for the market and this year's AI-fueled rally. Well, stocks already starting the week, though, under pressure as a 10-year yield briefly jumped above 5%. For more on this and the broader market landscape, we want to bring in Troy Gajewski. He's FS Investments Chief Market Strategist. Troy, it's good to see you. So already a lot to unpack, and still only Monday morning. We've had this massive run-up in yields, the 10-year just above 5% earlier this morning. And then, of course, this comes before the tech results later this week. How are we set up going into this week of earnings, and really what this could signal about the trading action we'll see in the coming weeks?
Yeah, so much of this has been driven by much higher yields, right? The fundamental driver, of course, is that the U.S. economy continues to be extremely robust on the consumer side in particular. Even with holding tax growth has popped back positive after contracting in Q2 and Q3. However, on the technical side, remember, there's Treasury issuance as far as the eye can see. The Fed is no longer the biggest buyer. They're the biggest seller. The Chinese and the Japanese don't have the wherewithal to buy what they used to. And then if you think about the U.S. banking system, the U.S. banking system has the capital to buy treasuries now. But after the book value destruction that happened earlier this year and late last year, there isn't a lot of impetus. So the technicals of the treasury market actually frighten us more than the fundamentals. And that clearly means another round of multiple compression and the potential for more downside pain in mega cap tech, which clearly led the rally this entire year and has been involved in the sell-off recently.
Troy, what type of risk factor do you believe that the yield environment right now, and as well, kind of combined with that, the Fed's rate hiking campaign, also puts on some of the earnings growth that investors are going to continue to look for over the course of this earnings season, and what CEOs are able to kind of dispel about the pathway forward from this point?
Yeah, so it puts even more pressure on explaining why some of these incredibly elevated multiples are justified. AI is obviously going to be a key driver of revenue growth and profit growth, but so far it's really only impacted NVIDIA. And yet we reflated back up to close to 19.5 to 19.8 times the S&P, and much, much higher in large cap tech. So our question hasn't been whether these are great companies that can grow earnings and revenue over time. It's whether they justify, or the multiple that people are paying is justified. And by June and early July, it looked like that was a dangerous assumption. But it's not all negative, right? This is a great time to be a private lender. It's the best opportunity we've seen since post-GFC, with banks retrenching and much higher yields in the front end. If you're focused on multi-strategy funds that benefit from higher risk-free and can take advantage of slower refi activity, there's still a lot of exciting opportunities. It's just in the short term, it looks like there'll continue to be technical pressure on mega cap tech. So the earnings have to be very strong, and there has to be guidance to justify the current multiple.
Yeah, and so with regard to that justification of current multiple, can you perhaps quantify the type of adjustment that needs to take place, that the markets should be looking for, especially considering some of the factors we just laid out?
Yeah, look, you're going to have to see solid earnings beats and guidance that gives people comfort that there'll be consistent revenue and earnings growth, even in a higher yield environment. So obviously, if there's misses, they'll be punished. If you're showing only 1 or 2% earnings growth vis-a-vis expectations going into this earnings cycle, if the 10-year was at 3.5, that would be more than enough. But in an environment where the technicals look like they could push the 10-year through 5% over the next 6 weeks, particularly into year end, you're going to need to see much stronger organic earnings growth and revenue growth than has been projected up until recently.
Troy, if we do see the yield hover right around the current levels, or potentially even trend about a little bit higher, how much pressure then are you talking about when it comes to some of these tech leaders and what we could see in terms of that downside risk?
Yeah, so it looks like the multiple bottom occurred last October, and we'd still say that's more likely than not. The issue on the top line, again, comes from, even though these are great growth industries, as recession risk has gone up meaningfully, it looks unlikely that we won't get lower lows in terms of price for this year, not as low as October. So we think somewhere between 5 and 10% more downside from here. Again, not wiping out the entire gains we've seen since last October, but certainly a significant hangover for some of the AI-fueled mania that we saw, particularly in May, June, and July, which was partially driven by extreme short covering from hedge funds that were a little too over their skis and short. So we'd be very cautious about adding into growth in the back half of the year. Wait for this yield scare to play out. And then as we get cues from the economy in terms of potentially avoiding a recession and pushing back cuts even further, that's when you probably want to get a little bit more aggressive going into early next year.
Troy, when you're talking about getting a little bit more aggressive going into next year, I guess, where do you see those opportunities? And also following up on what you just said about recession, maybe being able to avoid it, what does the probability of a recession look like to you today?
Yeah, so right now we still think it's around 60% over the next 12 to 18 months. There's really a virtuous feedback loop taking place, which has lowered those recession odds. It's the virtuous feedback loop between more state and local government spending, more CapEx and business fixed investment driven by the Inflation Reduction Act, a housing market that is now a contributor to growth, not a drag. And again, the labor market continues to be remarkably tight, driven partially by hoarding. So that's really, really good news in that, ultimately we can potentially avoid recession. If you're focused on floating rate lending strategies, you have more income than you expected and much less downside risk from defaults. And in terms of getting aggressive, what I meant by that is if you have a portfolio that's focused very heavily on cash and is also focused on alternatives that have less downside, particularly to this spike in yield, it certainly makes sense to continue to own large cap tech as a complement to things that can grind out more consistent returns. It's just that we've seen this cycle repeatedly, is that every time there's a new technical development, whether it's short covering or a strong bear market rally, then you throw the AI mania on top. There's an over enthusiasm for overpaying for very high multiple stocks based on the 2009 to 2021 environment. And we just don't think that's coming back anytime soon. So, we think much more like mid to low high single digit returns are in order for equities going forward. Add a few hundred basis points on that for mega cap tech. And what's so interesting about this environment is you can get very similar returns in the senior part of the capital structure, whether it's in real estate or in private corporate lending, which should be competitive to equities going forward. It doesn't mean you go completely to cash or to alternatives. You use them as a complement to some of your large and mega cap tech and market weighted indices like the S&P.
Some top shelf strategy and analysis. Troy Gajewski, who is the FS Investments Chief Market Strategist, for joining us this morning here. We certainly do thank you kicking off the week with us. Thanks.
Take care, everybody.
You too. Well, this is a big earnings week with some of the largest tech companies reporting. Microsoft, Meta, and other heavy hitters are reporting in the next couple of days, but there are more earnings and economic reports to watch for. For more on what to watch, Yahoo Finance reporter Josh Schaefer is here. All right, we got the logos on the screen. Josh, what are we watching for?
Brad, if we are doing an excitement meter, we have reached that part of the quarter, my friend. We've got over 160 S&P 500 companies reporting this week. Lots to break down in terms of markets and what it could mean when we think about these individual reports. You're seeing on your screen here, we've got Meta, we've got Microsoft, we've got Amazon. Lots of big tech names. Going to be curious what we hear about AI, of course. Also cloud spending in terms of Amazon and Microsoft. Also going to be interesting to hear from GM and Ford. This will be their first earnings release since that strike started. Now, of course, the UAW auto strike wasn't really taking part for most of the quarter that we already saw happen, but we should get a lot more insight on those earnings calls. Also going to take a look at Chevron and Exxon on Friday. Going to be interesting to hear what rising oil prices mean for those companies. And then when you take a look at the economic calendar this week, it's a little bit of a softer schedule, but a couple big releases for the economy this week. We're going to get that Q3 GDP reading on Thursday and a PCE index reading just before the Fed meets next week on Friday. Two key things to watch there. Of course, we're looking for inflation, core inflation to be coming down. It's expected to come down. And the economy supposedly grew, if the estimates are right, at 4.3%, the highest quarterly growth since Q4 of 2022. So we're looking for a big number on Thursday. I don't think that will surprise many people in terms of the hot economy story, but perhaps just another sign of how good that economy really was through the summer. The final thing, guys, that I want to leave you with that I really just think is important to think about this week is thinking about that Magnificent Seven reporting and what it could mean for the S&P 500. We've got 4 of those companies reporting this week. We know that's been a large driver of the index. Can that AI story, can tech earnings give a bump to stocks is one thing I'm watching this week. We know it's been all about yields, but could good tech earnings maybe give some upside or downside to the market is one thing I'm going to be watching this week.
Hopefully it's some upside. We need a little bit of better news here in the markets
better
as of
news.
late. All right, Josh, I know, you certainly have a busy week ahead, so we're going to let you go. Josh Schaefer, thanks so much. All right, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Taylor Swift making music history today, announcing she's going back on tour after a 5-year break.
Pre-sales for her upcoming tour kicked off yesterday, but a surge in demand caused Ticketmaster's website to freeze or even crash altogether.
There's so much fanfare around the summer that has been Taylor Swift.
The Philadelphia Federal Reserve mentioned the impact that her tour had on the economy. Jersey sales for Travis Kelce up 400%. His podcast hitting #1 on the Apple charts, all because of Taylor. Taylor Swift for Taylor Swift.
Taylor Swift.
For Taylor Swift.
Taylor Swift is breaking the internet again.
Almost 1 year ago, singer-songwriter Taylor Swift began a journey that would change the American economy as we know it, starting with ticket sales for the Eras Tour. Over 3.5 million people signed up for Ticketmaster's verified fan presale, but only 2.4 million tickets were ultimately sold. The unprecedented demand created a frenzy that resulted in a congressional hearing against the ticketing company, all while solidifying Swift's status as the world's biggest pop star. The tour kicked off in March of 2023 and has since blown up headlines and even landed in Philly's Fed Report. Analysts expect the tour to pass the $1 billion mark during its international leg in March of 2024. That would beat Elton John's nearly $940 million record for his farewell tour, which concluded in July. Swift's Eras Tour is also expected to generate as much as $5 billion in consumer spending in the U.S. People are dropping money on plane and hotel tickets, fun outfits and merch, $75 hoodies, $55 long-sleeve shirts, and we didn't even talk about ticket prices, with resale tickets selling between $500 to $7,000 a pop, and in some cases, even higher. And that economic impact has only grown beyond the tour, with Swift now rumored to be dating Chiefs tight end Travis Kelce. Ticketing platform StubHub reported a 175% increase in ticket sales after she attended one of his games. And according to fan merchandise company Fanatics, Kelce's jersey sales have increased by 400% since that first Swift appearance. And now her team is taking it one step further by releasing a big screen adaptation of her popular Eras Tour. Bottom line, the Taylor Swift economy isn't going out of style anytime soon.
Go back to sleep?
Live from the Nasdaq market site in New York City, we've got a lot on our radar this week. It is the most wonderful time of the year for shopping, and if the last few months of retail sales numbers are any indication, consumers are likely ready to spend or at least ball on a budget. There are some possible headwinds this year that may make things a bit different for customers and retailers alike. Holiday shopping season. For the first time in 3 years, millions of Americans will have an added bill to pay now that student loans are back. And retailers, after years of excess inventory, are cutting back on what they have in stock. Our next guest is here with tips on how to navigate this year's more complicated shopping season. Let's bring in Adam Davis, Wells Fargo Commercial Capital Managing Director. Adam, I would love to know what's on your shopping list, or perhaps what's in the cart right now. You're waiting for it to go on discount or promotion. We can get to that later on. What are the biggest things that customers need to know as they're looking for discounts or looking for promotions going into the holiday shopping season?
Yeah, so look, we've seen retailers bring down inventory levels to kind of right size where we believe or where they anticipate, the sales to be this year. We're calling it kind of a retail reset. There's a lot of uncertainty as it relates to where the consumer spending is going, and as you alluded to, there is a share of wallet concern as they think about, all the different macro environments, also the student loans. And so as you think about it, retailers are now trying to pull sales forward to capture as much of that share of wallet as possible. And so what you've seen is some early indication of sales, stores being set for the holidays. We've even seen retailers in September start to kind of do early promotions. And so although there's going to be less inventory in the system than, say, last year, which was a gluttony of inventory, I think that's where we're starting to see retailers start to be proactive, be really promotional, and pull those Black Friday sales, which kind of leaked into early November the last few years, and then pull them even further into, say, October. So that's what you're kind of seeing right now.
Adam, when it comes to the promotional activity that we're already starting to see, these sales, are they as good as they're going to get, or should we expect some of this promotional activity from these specific stores to get better and better for shoppers as we get closer to the holidays?
Yeah, so it's interesting that the retailers have been very strategic with the promotions right now, whether that's kind of a private sale to their loyalty partners or just doing kind of a broad 15, 20%. So you're going to continue to see them kind of pull levers throughout the holiday season, which will benefit the consumers. I think as we get closer to November, you're going to start seeing kind of an increase in cadence with promotions. And I think that's where I think the consumer is really going to benefit. If there's a must-have product, I would absolutely seek those items out earlier. I would get on the loyalty programs, see if you can get a sneak peek. Sometimes those loyalty programs have free shipping. Maybe there's a reward cadence or a reward program, as well as just kind of an early indication of upcoming sales.
Additionally here, when you think about the retailers and how much they're expecting perhaps some of the margins to be compressed, knowing the consumer demand environment right now where there is such a looking across and comparison shopping in specific categories, looking for the discounts, the promotions, and where that could also flow into some of the margins that are going to be hit here for retailers.
Yeah, look, the margins is really when you're kind of looking at retailing, that's really what they're focused at. I mean, you obviously want to have sales growth year over year, but it's really kind of the margins. And so as you're sitting there, the retailers that we work with are very focused on the margin dollars. And so being very thoughtful with promotions. Last year, when you kind of think about what has happened, kind of post-COVID, you had sales just ramping up like crazy in 2021. And there was a lot of money in the system. And so it didn't matter what you put on the shelves, a lot of products sold. Since then, what you've seen is the consumer pull back. There's a shift in what they're actually buying, from consumer goods to experiences. And so that kind of couples with that share of wallet kind of pressures that we're seeing. And so the retailers kind of think about it. And I think that the fact that they've reduced inventory levels year over year is a big part of kind of how they're going to try to protect those margins as best they can. Now, as we progress to the holiday season, their goal is to clear out that inventory and maximize sales between now and the end of December. And so that is really where you're going to see they're going to throttle up promotions as they get kind of a little further on. And what you're seeing is you kind of have to follow suit. So if their competitors are being really promotional, their hand is going to be forced to promote just as much. And so that's the piece that we're kind of watching. And I think that's where the consumer can really kind of pay attention to their favorite retailers, go out there, again, sign up for loyalty programs and kind of keep a finger on the pulse.
Adam, I'm curious, from your conversations that you've had with executives, with various employees here within the retail industry, just how are they feeling right now, and how are they navigating this very tough environment? You've been mentioning all the uncertainties that we have ahead, the fact that the consumers are feeling so much pressure. The ones that are doing it best, I guess, what are they doing, and what can others learn from them just in terms of best positioning themselves at this point in the economic cycle?
Yeah, so the ones that are doing the best are the ones that, own brands. And so those are the ones that, continue to do really well. Those are the brands that, you have the consumers can kind of relate to. The other ones, it's controlling the inventory levels and trying to create some buzz, whether that's bringing foot traffic into the actual brick and mortar stores, or is that a matter of, trying to create that kind of online experience, that true kind of omni experience. And then the third leg of that stool is the delivery model. Have they, improve their inventory management system such that they can, deliver inventory as fast as some of the other kind of digitally native businesses online. And so those are the ones that are doing it by far kind of the best as you kind of think about it. But the uncertainty continues to be out there. It's everybody, I wouldn't say they're necessarily worried, but there is a focus on a kind of week to week, what are you experiencing? How is September versus what we're seeing for October? How do we pivot? Sales and marketing, we've lowered our inventory levels. Are those the appropriate levels, or do we actually start to increase inventory levels and chase sales in certain products that have really good sell-through?
All right, certainly something we're going to be watching here this earnings season. Adam Davis, always great to get your perspective. Wells Fargo Commercial Capital Managing Director, thanks.
Thank you for having me.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. UAW has officially expanded its strike to a Stellantis truck plant in Michigan. This is breaking news out earlier this hour. The walkout will include 6,800 workers after the union said that Stellantis has the, quote, worst proposal on the table regarding wage progression. We certainly know that many of these automakers have been under a tremendous amount of pressure. Now, the strikes began more than 5 weeks ago on September 15th. And to give you a better idea of where the strikes stand right now, we have the Detroit automakers. More than 40,000 members of the UAW are on strike here. This strike brings that total to more than 40,000. Certainly lots of pressure on Ford, on Stellantis, on GM to reach a timely deal here with the UAW in order to get back to work, in order to mitigate some of the financial pressures that they are feeling as a result of this strike going on for more than 5 weeks. And it's also important to point out that this plant is one of the most important plants to Stellantis in the U.S. Now, they are just a bit better poised, it is thought here, to weather some of this downturn because of this stoppage at the pickup plant than GM and Ford, just given their numbers and the production happening specifically at this plant. But still, the targeted approach of this strike is something that we have noted many times before here on Yahoo Finance, clearly having an impact when it comes to that day-to-day financial impact of these automakers.
It was just a couple of weeks back that we heard from the UAW president, Sean Fain, who had said that, hey, we're not just going to do Friday updates and then announce which strikes are coming forward. This really puts some of the automakers on their heels, and especially as we're continuing to watch where this could play out for, as you were mentioning, Ford and GM, if this expands further. Ford shares over the past month, they're down by about 7.3%. You take a look at the past 30 days for GM, down by about 9.3%. So this is directly impacting how investors are looking across the labor negotiations, but also what that future spend profile might look like for a set amount of headcount that's necessary, not just for the combustion engine vehicles that are already being produced, but this is all about where that electric vehicle production and even some of the robotics and artificial intelligence that get woven into the future fabric of manufacturing these highly technological vehicles that are going to be coming to market and the negotiations that go forward. That is all encapsulated within this broader negotiation process here. So this is just the latest on that front. We'll continue to monitor, of course, and get you any more updates that we see, especially as shares continue to move around here this morning.
And again, more than 40,000 union members working at Ford, at GM, and Stellantis are now on strike since those walkouts began last month on September 15th. All right, let's get to the latest down in D.C. 9 Republicans have announced their intention to seek the speakership as a deeply divided House GOP failed last week to elect a new leader. A forum for the hopeful candidates will be held later today, and a vote to narrow down the list is scheduled for Tuesday. No bills, including President Biden's $106 billion aid request for Ukraine and Israel, can pass the House without a speaker in place, and House Republicans remain deeply divided. Joining us now, I want to bring in Steph Knight, Axios politics reporter. Steph, it's good to see you. So now we have 9 GOP members throwing their hat in the ring, going for a House Speaker. Give us a sense just in terms of how where their support lies, and also just what this means if we are any closer, it doesn't sound like it, to eventually getting a Speaker for the House.
I mean, you look at the fact that we do have 9 different candidates who have thrown their names in, and it does go to show just how far we are from having a consensus candidate for Speaker at this point in time. Of course, this comes on the heels of 2 failed Speaker bids by, Steve Scalise and Jim Jordan. And now it seems that everyone feels like they have an opportunity to try for the speakership. And, according to our reporting, discussions with some of our Republican sources, there are definitely some members within that 9 who are more likely. Of course, Majority Whip Tom Emmer is considered one of the likely candidates, but even Byron Donalds, who's a relatively newer, younger member of Congress, he is also considered to have a pretty serious opportunity here, given the fact that he is often sided with some of the more conservative side of the party. This year, he was one of those who withheld his vote from Speaker McCarthy initially in January. So there are just so many names. We'll have to see how this shakes out, but it does go to show just how, chaotic this process has really become.
So this also is going to loom large, especially as we are just days away, well, just about a week outside of the beginning of November. And of course, in November, that's the potential deadline for the government shutdown. Not just the potential deadline, it is the deadline. And so what does this make, how much more difficult does this make actually getting to and through a resolution once we get to that date?
Well, exactly. As you point out, there are so many things that are on the agenda that the House has to get done. Of course, funding the government or coming up with some kind of a short-term solution to push that deadline back like they did last time, a process that led to the ouster of Kevin McCarthy as Speaker. They also are now being they were presented last week with the White House's $106 billion package, which includes aid to Ukraine and Israel, as well as significant border security funding. That is obviously a top priority for many members in Congress, Republicans and Democrats, who view this time as a critical moment for the U.S. to be supporting our allies in Ukraine, in Israel. And of course, we've also continued to see the border issue become a focus from Republicans, but also the Biden administration. So there are some big ticket items on the agenda for the House, and it's something that they need a leader, a speaker in place for, whether that is a new speaker who gets elected in the next few days, or whether we ultimately see Republicans have to work with Democrats to empower the current speaker pro tempore, Patrick McHenry.
Steph, you mentioned some of these congressmen may be better positioned than others just in terms of the support that they'll likely garner here at this point. Are you confident, though? I guess when we try to figure out what this means for the future of the GOP party, we've talked about the fact time and time again that this is a party that's deeply divided. Is one candidate to you maybe sticking out amongst the rest in terms of who is best positioned or has the ability to unite the party to move forward?
This really lies at the heart of the issue that we've seen with Republicans over the past few weeks. The truth of the matter is someone like Tom Emmer seems like he could be the kind of candidate who would get the most support across the party because of his role in leadership over the years. But again, he's not one of those that necessarily is going to win over some of these more hardline Republicans who we have seen are more than willing to flex the power that they have because of the slim majority. And it puts the Republican Party in such a precarious situation. With Jim Jordan's failure to win the speakership, we saw that even when you have a candidate that is able to cater to some of the far right sides of the party, he still is not going to be able to get enough support from moderates to get those necessary votes to move his nomination across the finish line. We've seen examples of, over the past few weeks, how a more moderate approach doesn't work because the conservatives won't get behind them. And also a more, conservative friendly candidate also can't get across the finish line because of moderates holding out. So it's really hard to see, looking at this list, which one would be most likely to win the whole party. I'm sure we'll have a better sense of whether anyone comes out of this with a better chance of winning the speakership after they have an opportunity to make their pitch to the caucus later today. I'm sure coming out of that meeting, we'll start to get a better sense of who is really at the top of this list.
All right, Steph Kite, a lot to continue to keep eyes on in the Beltway there. Axios politics reporter Steph Kite joining us this morning. Thanks so much, Steph.
Thanks for having me.
Absolutely. Well, let's shift gears. Let's talk a little Taylor Swift. Why not? Because it's 10:52 and we haven't yet. Taylor Swift is maintaining her crown as queen of the box office this weekend after Martin Scorsese's Killers of the Flower Moon failed to knock her out of that first place spot. Apple's Western crime film took the second spot at $23 million, with Swift's Eras Tour concert film bringing in another $31 million domestically. Yahoo Finance's Alexandra Canal and resident Yahoo Finance Taylor Swift expert. I'll just give you that title.
Yes.
Why not? You've got all the details on this. Ali, what do we know?
Yeah, Taylor Swift, as a fellow Swift team, she's still #1 at the box office. However, Killers of the Flower Moon, not such a bad start, considering this was a period piece, considering we still have the ongoing SAG-AFTRA strike, a lot of these actors unable to promote their projects. But this film, it's going to have to make up some serious ground if it wants to be profitable. Apple paid an estimated $200 million before marketing costs on this movie. Some estimates have that even higher at $250 million. But with the backing from Apple, which doesn't necessarily ride or die on the theatrical successes of its film, it might not be such a big deal. Apple, of course, is heavily leaned in to the box office, committing $1 billion to theatrical exclusives set for release later this year and in the future, matching the likes of Amazon. We have a few other titles from Apple coming out later this fall, which will also be exclusive to the box office. And it's a strategy that's really different from some of those competitors in the space, like Netflix, for example. Netflix has really stressed that they want to make Netflix movies for Netflix consumers. So we'll have to wait and see how the rest of Apple's theatrical releases perform and whether or not that will convince Netflix to perhaps change up its strategy there. But just going back to Taylor Swift's Eras Tour movie, I mean, this was a film that came out of absolutely nowhere. And although the audience did drop off pretty significantly from the debut to weekend number 2, the fact that it's still ruled at number 1 is very impressive. Year to date, the overall box office is sitting at just under 87 million, which is about 24% lower compared to where we were at this point last year. But this movie, this concert experience, it is helping to boost those numbers and could be exactly what theaters need to try and reach its goal of $9 billion in domestic ticket sales by the end of this year. So we'll see. I mean, Taylor Swift, the kids love her these days, and they're continuing to go out and show their support at theaters.
Allie, the kids certainly do love her. It's been remarkable how many fans went out early and bought these tickets, how many have shown up at the theaters here over the last 2 weekends. When we talk about how sticky, though, this model is, it's something that you and I and Brad have talked about in the past. Are we learning anything different just in terms of what we could expect, maybe the strategy for some of these bigger names within the music industry, how they could potentially approach a deal like this with some of the movie chains?
Yeah, and it's interesting to look at the Eras Tour movie in particular because it's only available to see on the weekend. So it's not like a normal box office film where you could see it on a weekday, on a Monday or Tuesday. This is only for the weekends. We do have Beyonce's Renaissance Tour also coming out to theaters later this year and in December. So that'll be interesting to see how that performs, considering it's a little bit more documentary style, where Taylor Swift, it's truly the concert experience. You were up, you were dancing in your seats. But like I said, that drop-off between week 1 and week 2 was pretty significant. I think it was over 60% less. And that's usually what you see with big box office films as well. And, you know, the more people go and see this movie, obviously the hardcore fans, they have already seen it right at the front there. So we'll see how sticky and how long this could actually last. But you're seeing that the lack of competition at the box office right now is really helping this movie stay at number 1. And at a time when we really don't have a lot of other titles, it's very welcoming, I think, to the box office to have something like this to lean on.
That Beyonce Renaissance Tour film, Allie, I can't wait for that personally. I might have to show up to the theater wearing a gingham top, some crochet pants, and some platform shoes. I don't know. It's going to be Soul Train all over again. I can't wait. Yeah.
Amazing.
A real visual with that one.
I mean, it's gonna need to be a team trip. We all got to do it.
All right. It could be a lot of fun. I'm telling you, I haven't gone to see Taylor Swift's concert at the theaters yet, but I've seen a heck of a lot of posts on it on social media, and it looks like a ton of fun. So I get why so many people are so excited and going out, even though if they saw the concert, they're going to theaters to check it out one more time. All right, Allie, thanks. Let's do a quick check of the broader markets here about 90 minutes into the trading day. You're still looking at pressure for the Dow and the S&P, although just below the flat line. You actually have the Nasdaq flipping into positive territory, up just about 0.1%. That's all from us today, but keep right here on Yahoo Finance. Rochelle Akufo has you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo, and here's a look at what I'm watching this morning. Soaring yields still weighing on markets. The 10-year Treasury yield continues to flirt with 5%, spooking investors and driving weakness in equities. Plus, big tech on deck. All eyes are on earnings this week for some good news. Investors are looking for enterprise software and advertising expected to stabilize thanks to resilient client spending. But how big of a mention will AI get? And opening the door could be the key to affordable housing. Could it be in your backyard? Well, we're taking a look at new legislation aimed at accessory dwelling units, or ADUs. Why the mini units could be the key to cheaper housing options. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. We're seeing they're all currently bobbing around the flat line here. The Dow just barely in negative territory, down about 22 points. S&P 500, they're also up just barely by about a point. Tech-heavy Nasdaq, they're the strongest gainer so far, up about 0.25%, have been gaining some momentum in this big week for tech earnings, while also mulling the action they're seeing in the Treasury market as well. With that in mind, let's take a look at what's been happening with the Treasury market. The 10-year dipping below that 5% threshold, but ever so slightly, currently standing at 4.9. We see the shorter-term 5-year yields down ever so slightly as well, but the longest-term 30-year still above that 5% threshold, currently down 1% on the day. Well, the bond market is back in focus as another sell-off sends Treasury yields surging, with the 10-year flirting with 5%. Now, for investors who've been around for a decade plus, major volatility in the bond market can be pretty scary. To learn why, we want to look to a country that only recently made a comeback after debt sent its bond market crashing and its economy reeling towards bankruptcy. Greece. Now, the nation's credit rating was raised to an investment-grade BBB- by S&P Global on Friday. Here to break down all of this for us is our very own Inez Ferrer. Inez, I remember when Greece was all the rage, they were expecting it to go bankrupt, and somehow it's turned this around.
Yeah, you remember those riots that were going on because of austerity measures back in 2012, the debt crisis that Greece was going through. Well, this is the first time that Greece's credit rating is raised by one of the big three assessors since more than 10 years now. And by the way, the big three assessors being S&P, Fitch, and Moody's. And in this case, as you had mentioned, S&P raising its credit rating to a stable outlook on Greece, lifting the nation out of junk territory. This follows some overarching themes. June's re-election of Greece's reformist prime minister, his initiatives, and also his promises, including reducing the country's debt versus GDP. And the S&P statement as to why they did this reads, significant budgetary consolidation has placed Greece's fiscal trajectory onto a firmly improving track. They go on to talk about a very rapid economic recovery. This is very important because the Greek government expects its economy to expand by 2.3% in 2023 to 3% in 2024. Tourism at a record high. The country has been booming with investments as well. Goldman Sachs recently talking about capital expenditure in Greece, capital formation, as it's been building its productive capacity, more plants, more machinery. You've got Microsoft, Pfizer that have been investing in Greece. So the economy has been booming. And all of this has been positive for Greek bonds. Greece's bonds are now the best performers in the euro area. Its 10-year government bond is yielding at 4.3%. By the way, back in 2012, that 10-year government yield, the government bond, was at 41% back in 2012. It's down now to 4.3%. Remember that bond prices and yields move inversely. So as investors want to now buy more government bonds, Greek government bonds, this is more positive for the country. It's just more positive for investment. The cost of borrowing is less expensive in that case, and the economy is booming. A real turnaround from what we saw back in 2012.
Certainly a real stand-up when you look at economies that were in a lot of trouble, as you mentioned there, about 10 years ago. Appreciate that update, our very own Inez Ferrer. Thanks so much.
Thank you.
Well, elections across the world are putting emerging markets in focus for investors, as new leadership could mean new opportunities. Argentina's presidential election currently in a runoff with left-wing candidate Sergio Massa leading. Now, this comes a week after Ecuador and Poland vote in new pro-business leaders. And on deck for the coming months are Egypt, India and Mexico. According to Bloomberg, those 6 elections can affect more than $200 billion of sovereign bonds. Well, joining us now with his insight into these emerging market moves is Simon Quijano-Evans, GemCorp Capital Chief Economist. Thank you for joining us this morning here. So first, I want to sort of set the scene here, because we talk a lot about rating agencies and how they assess emerging markets, but then you also have your reality index as well. So give us a lay of the land here, especially with these elections in mind, as to what sort of opportunities you see.
Well, it's very interesting. The elections do form part of this more qualitative backdrop that you're looking at. And if you look at some countries, especially sub-Saharan African countries, then they do look underrated. And you were just talking about Greece just now. And I remember 10 years ago when Greece was pushing through a whole load of things before elections, after elections. Well, the same thing is happening in emerging markets. And I think looking at, in general, what we're starting to see, as you mentioned, is some positive green shoots. For example, the elections results in Poland, where we see a more reformist government, less nationalistic government coming in Ecuador, hopefully a calming down of the situation there. Looking ahead, it's going to be tough. And I think that emerging markets are really very much going to be driven what's happening in the Middle East. But let's face it, year to date, spreads in emerging markets on the EM US dollar bonds have been very flat at about 450 basis points. And it doesn't look as though that picture is really going to change very much.
So then, based on what you're seeing then, which are some of the most undervalued emerging markets?
So if we take countries like Kenya, for example, even Ghana, which is going through a restructuring phase, you have countries, for example, like Indonesia in Eastern Asia. You have countries perhaps like even Ecuador, potentially also Argentina. And what the qualitative data are telling us, this reality index, as I call it, which takes into account education levels, female to male labor force participation rates, internet access, for example, to empower the populations for future democracy. All of these things show that a number of emerging market countries are underrated. And I think ratings agencies, as we move ahead, need to look more into these qualitative aspects, not just the quantitative type of data that we're seeing as they've always used.
And so then, as we look at some of the returns that we've seen in different aspects of these emerging markets, then what are the real standouts here?
I think, well, on the downside, if you like, obviously countries like Turkey, which have had problems on the political side getting involved in monetary policy. Looking ahead, there's been a real change to the economic team there, the macro team led by Finance Minister Şimşek and the new central bank governor. So looking ahead, there's potential for Turkey, for example, to catch up both on the dollar bond side and the local currency side. If we look at the currencies in emerging markets, you see countries like Brazil, Mexico, even Colombia outperforming other emerging markets, and indeed many developed, so-called developed market currencies out there. Why? Simply because their central banks have been much more proactive. They've had positive real interest rates, which we've only started to see, for example, from the Fed in the last 3 to 6 months, and still not fully seeing from the ECB and Bank of England. So I think those countries that really have outperformed are the countries which have been much more proactive on the central bank side and much more cautious on the dollar bond side.
And I do want to ask you about some of the shifting dynamics, obviously, because of geopolitics, and especially Saudi Arabia. What is the focus there, especially when you think of their dynamics with China and some of these other superpowers, and what some of the moves that we've also seen with the dollar, given what we've seen with inflation?
Well, GCC countries are very much driven by oil and natural gas sales, whichever country you're looking at. Saudi Arabia is really on a reform path towards that so-called 2030 agenda. All kinds of renewable energy projects, the projects for real estate, the projects for water, for education, for increasing the awareness of society to the outside world. And I think that this is moving in the right direction. So as we see the situation I would say becoming more risky, obviously, in the Middle East. A number of countries are going to have to look how to position themselves. And clearly, Saudi Arabia has been trying in this attempt to improve relations with many countries in the region, including Israel. And I think this is something that we're all focusing at the moment for the next 3 to 6 months.
And just very quickly, a word of advice for anyone who's new to investing in emerging markets. What should they put on their checklist?
Well, that's a very very interesting question. And let's face it, if you look at the classic bond indices out there, the dollar bond indexes, then you have 70 plus countries which are constituents, which are members of these indices. It's a wide spectrum of country. There's a lot of diversification within those indices. I think for somebody who's looking to enter the markets, in emerging markets, maybe the dollar bond indices, ETFs are the first step, given that you have a lot of diversification and you have a lot of stories that you can't possibly look on or look at an individual level. If, as an investor who's entering emerging markets for the first time in the local currency bond space and indeed in the equity space, you're going to have to take into account foreign exchange risk and to maybe hedge yourself there. But there are a lot of more risk which needs a lot of more time to analyze, basically.
I appreciate you breaking that down for us. Simon Quijano-Evans, GemCorp Capital Chief Economist, thank you for your time this morning.
Thank you.
All right, we're watching shares of Stellantis on the move this morning. That's after the United Auto Workers Union expanded its strike to 6,800 workers at a Ram full-size pickup truck plant in the suburbs of Detroit. The UAW saying in a statement that Stellantis has, quote, has the worst proposal on the table regarding wage progression, temporary worker pay, and conversion to full-time cost of living adjustments. The strike is now entering its 6th week, and this latest move means there are now over 40,000 workers on strike at 7 plants and 38 parts warehouses across the big 3 automakers. Now, UAW President Shawn Fain said in recent remarks that despite these record contracts being offered, there is still more to be won. Stellantis is now offering a 23% pay bump, eliminated wage tiers, offered profit sharing, and more. We'll be keeping an eye on that story for you. Right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. We're coming up on the 4th week of former crypto billionaire Sam Bankman-Fried's fraud trial. Over the past 3 weeks, the prosecution presented its share of witnesses, including 3 of Bankman-Fried's closest colleagues who delivered testimonies against him. Well, now it's the defense's turn to present their case. The question remains, will SBF testify? We have Brady Dale, crypto reporter for Axios, here to tell us more. Good to see you again. So with that in mind, will he or won't he? And is it going to make it better or worse for him, you think, if he does testify?
I think there's almost no reason for him not to testify. The trial is going so bad, and it's hard to imagine that they've got, anything super compelling from the defense's side. Their only hope is that, like, Sam could potentially charm the jury or, sort of spin a story that they find fascinating and sort of knock out a couple of the charges. The biggest danger in my mind, normally clients are advised not to testify, right? But it's just the case against him is so strong at this point. The only danger I see for him is sort of irritating Judge Kaplan, so that if he is ultimately convicted, the person who decides his sentence, if he finds something he says, unappealing, he could give him a worse sentence. So that to me is the biggest danger. But it's in such a bad state. It's like, why wouldn't he take the stand?
So then, what is he going to need to prove at this point?
Okay, so the crucial thing is, and this is what is weird about these kinds of cases, is he doesn't need to show that he didn't take a bunch of customer money. He needs to show that he didn't have fraudulent intent. And that's what could save him. Like, if he didn't actually think he was committing a crime, if he didn't actually believe he was doing something wrong, then he hasn't committed fraud, as weird as that is. You can take $8 billion from people, but if you don't think that you were doing the wrong thing, if you thought it was legal, then it isn't really fraud. So, if he can convince the jury that his mind and his heart were really in the right place, they might end up not convicting him of fraud. Though it does, based on everything we've seen, it feels like a real long shot.
And honestly, usually in these cases, those closest to you would speak on your behalf. In this case, those are the ones actually testifying against him in his inner circle. Who then do you think, witness-wise, could potentially step up here for SBF?
I mean, we haven't heard anything about someone involved at FTX or an investor or anything like that being planned to take the stands. But of note, in this courtroom, they don't ever actually have to tell us in the public ahead of time. So they could have somebody. The only witnesses that we know of right now is there's 3 expert witnesses that may or may not take the stand. The judge knocked out a bunch of the expert witnesses that the defense wanted to bring, but there's 3 left. So those could come up, but there's no one that we know of so far to counter Caroline, Nishad, and Gary. There's no one who it seems that we know of so far who would make the argument for Sam that within the company what he was doing looked like the right idea. The perhaps most notable thing that happened, besides the 3 of them, is his lawyer took the stand last week, or FTX's lawyer, Can Sun, took the stand and said, look, I definitely never advised that any use of customer funds was okay. I didn't know it was happening until the day before I resigned on November 11th. And that looks really terrible for the defense, because one of the arguments that we know they wanted to make was that Sam was acting under the advice of counsel. In other words, he had lawyers who said what he was doing is okay. Well, the FTX lawyer testified he definitely didn't say that. And so, again, it just looks terrible for him.
So then how difficult is it to prove intention based on what we've seen with his exchanges, DMs with reporters about lobbying and his other interactions and the surprises that came out? Do we get the sense that he's on the right track for proving his intention?
We definitely don't get that sense. But the thing is, to keep in mind, it's only been the prosecution thus far. The defense has not started to make their case. But, when you look at the fact that, it isn't just that in the FTX terms of service, it suggested they wouldn't use customer funds, but he went before Congress. He went before the House and the Senate and said, we don't use customer funds. We segregate everything. We keep everyone's funds really safe. He said that out loud. It's going to be really hard to convince the jury, like, yes, I lied about that. I lied about that in the halls of power in Washington, D.C. I lied about that on C-SPAN. But it's still, my heart was in the right place. I didn't have fraudulent intent. I just, it seems like an impossible lift to make. But that's what he has to do somehow to keep out of jail.
So Brady, what are you going to be watching for in this coming week? Obviously, a lot of crypto investors probably watching, regulators as well, although the industry does seem to be, moving beyond him at the moment.
Mm-hmm. Yeah, I do think broadly SBF's impact on the crypto market is over. Now, if it is true that the FTX debtors recover most of the money that people lost, that's going to be a ton of potential investment coming forward. But in terms of what I'm watching on the trial, yeah, like, does Sam take the stand? It seems likely that he will. Is there anyone from within FTX who will take the stand to support him, or other people who are involved in the FTX world, such as investors? That's the biggest question for me. And then how long is he on the stand for, and how well does he stand up to prosecution's questioning if he does? Right now, I think all of us, there's sort of a gang that's formed at the courthouse every day. And I think all of us expect Sam to take the stand. And we really think that he's probably going to be the defense's main witness, besides maybe a couple sort of technical experts who lead off to try to undermine some of the prior testimony from the prosecution. But yeah, it seems like Sam will be most of the case. And I think this case will actually end up wrapping surprisingly soon, sometime in the next couple of weeks.
Well, I know we'll check back with you and get that word on the ground. Appreciate you joining us as always. Brady Dale, crypto reporter for Axios. Thank you so much.
Peace.
All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with their assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Now for today's chart of the day. New home listings ticked up in September by 1.4%. That's the largest increase since February of last year. But total active listings still sit near the lowest level on record, with owners less keen to sell amid soaring rates. But home purchases are getting cancelled at the highest rate in nearly a year. Of all pending home sales, more than 16% fell through in September nationwide. And of the metro areas that saw the highest percentage of pending sales fall through, Atlanta topped the list at 24.4%. Interestingly enough, the other top cities where deals fell through all were in Florida. That's Jacksonville, Orlando, Tampa, and Fort Lauderdale clinching the top spots. Well, mortgage applicants are facing the highest cost of borrowing in more than 2 decades. But even if home prices continue to climb, buyers finding themselves sidelined could be in for some relief in 2024. Yahoo Finance's Danny Romero joins us now with more. So, Danny, talk about this silver lining that I know a lot of home searchers have been looking for here.
It's a silver lining that you're going to have to wait a little bit. Morgan Stanley expects that home prices will go up by Christmas time. And that's quite a bit of a change from their previous expectation that home prices would fall about 4% this year. Well, how did Morgan Stanley get to revise this forecast? Well, there's several factors that weigh into that. Home prices nationally have gone up 5.3% in the first 7 months of this year, and that is a record high. Another thing, supply still remains constrained there as well. A lot of homeowners are really reluctant to move. They're staying put. They don't want to buy a top price home right now. Who's to blame for that? But mortgage rates also have gone up from 3% to 8% in under 2 years. With that in mind, the pullback in supply really will add pressure to home prices. Morgan Stanley expects home prices to go up about 5% this year. Now, there are some bright spots, so there is some relief. Morgan Stanley expects that mortgage rates will fall by the middle of next year. And if they don't, then prices could be under pressure in a positive way. So if mortgage rates do stay in this elevated rate, sales and volume transactions stay muted how they are right now, and about 5% of housing supply actually gets added to the market next year, then we could see some home prices come down about 5%, Rochelle.
All right, certainly so some relief then. But yes, as you mentioned, people will have to be a little bit more patient. Appreciate it, as always, Danny Romero. Well, with many sidelined from the housing market by sky-high price tags and borrowing costs, alternative options are looking increasingly interesting. Enter ADUs. An accessory dwelling unit, or an ADU, is an independent living quarter built on the same lot as an existing residence. Now, they can be attached like an above-garage dwelling or completely separate from the main home. Now, while some build them to house additional family members, they can also be rented out for extra income and adding much-needed housing to areas short of affordable options. Now, states are opening up new possibilities for the spaces with new policies in California. An ADU can now legally be converted to and sold as a condo. And when underwriting a mortgage, lenders can now count a portion of estimated rental income from ADUs. Mike Koenig is the co-founder and president of Studio Shed, the leading manufacturer of accessory dwelling units and backyard structures. Thank you for joining me this morning. So give us a lay of the land here. With these new policies opening up, what are some of the investments and the opportunities that now come with this expansion?
Yeah, I think first, there's a lot of investments, I believe, to be made in terms of just adding income to your existing property. And for, say, real estate investors who are looking to, I think as the climate gets a little more, say, riskier or capital becomes a little harder to obtain with rates, you can effectively take like an apartment building and spread it out over many homes.
So then for people who are wondering if they build their ADU in their backyard as a separate unit here, how does that work when they're trying to sell their property? Will they have to sell the ADU with the main residence as well? Or how does that get navigated?
Yeah, well, California just passed Bill 1033, and Seattle has already been doing this for, I believe, a couple of years. And it's effectively you're parceling off that part of the real estate, so you can just sell off the ADU or the home, and it just becomes zoned as a multi, like a condo.
So, I mean, then for people who are wondering about regulations, obviously it's different state by state. We've seen California leading the way here. What are the main questions that you get about regulations for people who are interested in building an ADU, say in their backyard or on top of their home?
Yeah, so some of the typical questions are, one, can I put an ADU in my backyard? And then the second is, well, how big can I go? Our products range from studio style ADUs to we offer a up to a 2-bedroom, 2-bathroom. So the first is, can you do an ADU in your backyard? And then the second, of course, is what size should they go with? Now, it is becoming easier as the weeks and months go on, as municipalities combined with better zoning policies on the state level to effectively get an ADU in your backyard. It historically has not been easy. I think with the new FHA policy on financing, it obviously opens up access on a much broader level because you can qualify your income for the underwriting. And of course, with California Bill 1033, I think other states will follow, like, again, Seattle or Washington already did. So I think the challenge remains really on the municipal level, and the speed at which the municipalities are able to expedite the permits. That's really the longest stage in the whole cycle. Whether you're a studio shed like us, I mean, ours is faster because we have pre-engineered buildings and plan sets and all these things, but there's a disconnect between the number of ADU units that each municipality has a goal of. Denver, for example, wants to do 20,000 over the next, I believe it's 10 years. But there's such a lag on the municipal level. So that's something I think is the next opportunity for cities to work on.
So, Mike, with that in mind, then, how far do you think adding ADUs into the mix is going to go into solving the affordability issue and the inventory issue that we're currently seeing in the housing market?
I think it's never one thing, right? So I think that there's a lot of changes that need to be made. And again, I think that speed is critical. So I think you're seeing more, prefab or hybrid prefab 3D module solutions coming out. And, the ADUs are an excellent way to offset the high price of real estate and quickly add more doors or beds, if you will.
Well, I appreciate you taking the time to break all of that down for us and this, interesting developments that we're seeing here, especially as people might be looking for some extra sources of income as well. Mike Koenig, Studio Shed co-founder and president. Thank you for taking the time today.
Thanks so much, Rochelle.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Taylor Swift making music history today, announcing she's going back on tour after a 5-year break.
Pre-sales for her upcoming tour kicked off yesterday, but a surge in demand caused Ticketmaster's website to freeze or even crash altogether.
There's so much fanfare around the summer that has been Taylor Swift.
The Philadelphia Federal Reserve mentioned the impact that her tour had on the economy. Jersey sales for Travis Kelce up 400%. His podcast hitting #1 on the Apple charts, all because of Taylor.
Taylor Swift. Taylor Swift.
Taylor Swift.
Taylor Swift.
Taylor Swift is breaking the internet again.
Almost 1 year ago, singer-songwriter Taylor Swift began a journey that would change the American economy as we know it, starting with ticket sales for the Eras Tour. Over 3.5 million people signed up for Ticketmaster's verified fan presale, but only 2.4 million tickets were ultimately sold. The unprecedented demand created a frenzy that resulted in a congressional hearing against the ticketing company, all while solidifying Swift's status as the world's biggest pop star. The tour kicked off in March of 2023 and has since blown up headlines and even landed in Philly's Fed report. Analysts expect the tour to pass the $1 billion mark during its international leg in March of 2024. That would be Elton John's nearly $940 million record for his farewell tour, which concluded in July. Swift's Eras Tour is also expected to generate as much as $5 billion in consumer spending in the U.S. People are dropping money on plane and hotel tickets, fun outfits and merch, $75 hoodies, $55 long-sleeve shirts, and we didn't even talk about ticket prices, with resale tickets selling between $500 to $7,000 a pop, and in some cases, even higher. And that economic impact has only grown beyond the tour, with Swift now rumored to be dating Chiefs tight end Travis Kelce. Ticketing platform StubHub reported a 175% increase in ticket sales after she attended one of his games. And according to fan merchandise company Fanatics, Kelce's jersey sales have increased by 400% since that first Swift appearance. And now her team is taking it one step further by releasing a big screen adaptation of her popular Eras Tour. Bottom line, the Taylor Swift economy isn't going out of style anytime soon.
The 10-year Treasury yield dropping from that 5% mark. It's surpassed that level for the first time since 2007 on Thursday. Now, according to Mizuho's Peter Chatwell, that's a psychological level as much as anything else. Even so, elevated yields don't tend to be great news for growth stocks. And with tech earnings hitting this week, there's lots to digest. On the rising yield environment, our next guest says for investors, quote, seeking both yield and safety, this presents an attractive alternative to the stock market. Well, joining me now, Anthony Saccaro, Providence Financial Insurance Services President. Thank you so much for joining me today. So give us this lay of the land. People want to play it safe. Usually that would be bonds. Is that still the way, and considering how much potential upside there still is?
Well, that's the issue, is the bond market and the rising yields now are giving the stock market direct competition. There's this battle going on between the stock market and the bond market. You know, the stock market or the bond market is clearly telling us that the economy is strong and everything is is going to be great going forward. The inverted yield curve has become less inverted. There's been a steepening of the yield curve, so less likely potential for recession. But the stock market is giving us some mixed signals. The earnings reports over the last couple of quarters haven't been great. We're hoping that Q3 increases and Q4. That's what the market is looking for. But you look at the labor market, still very strong. You also look at GDP and you look at inflation, and that's going to stay elevated. And that's not potentially going to be good for the stock market. And the bond market, the 5% yield is a direct competitor of the stock market now. But because it looks like a recession might be less likely, investors in stocks are demanding a higher yield in bonds. But if you're close to retirement or you're going to need that money soon, I mean, I really think you probably should think about locking in some longer term yields at this point. That's something you haven't been able to do for a long time.
It's true. And Anthony, a lot of people are wondering then, where are the safe havens then? Since there is still some uncertainty, potentially the Fed signaling it could raise rates again in December, saying that's not off the table. What do the current safe havens look like in this environment?
Well, certainly fixed income is, in my opinion, a safe haven because the income is the one thing that you can count on. There's so much up in the air right now. There's not a shortage of things to look at across the world that could cause the stock market to tumble. And we've had that before, right? We had the tech crash no one expected. We had the financial crisis that at that moment no one expected. The stock market tends to do the opposite of what you think it's going to do. And when people are feeling strong about things, when people are feeling good about things, the stock market tends to do the opposite. So it's not time to let your guard down. What we tend to focus on for our clients at Providence Financial is we focus on income, because if you're invested in a high quality portfolio of fixed income investments or even stocks that yield 3 or 4% in a highly diversified portfolio like we're getting for our clients, the one thing you can count on over the next 10 years is income. And I want to know that no matter how you're invested, you have something you can count on. I don't think you can count on share price right now, but income and dividends you can count on.
And so in terms of the fixed income that you like, I mean, we saw some commentary from Bill Ackman, covering his short in this, and people are trying to really assess whether they should be looking at the longest term yields. Which ones do you think are most attractive, especially since we don't know what's going to happen with oil prices and the hostilities in the Middle East, what's going to happen with China and these other things that's also affecting inflation, some of these stickier parts of PCE?
So I think it depends on what stage of life you're in. I think if you have 10 or more years until you're retired, fixed income absolutely should be a part of your portfolio for two reasons. One, yields are higher. You can lock in 10-year yields right now at close to 5%. We've seen that 10-year yield fluctuate all morning, and right now I think it's just shy of 5%. But if you can get 5% guaranteed for 10 years, that's a phenomenal, that's very attractive. The other second reason for locking in maybe 10-year yields at this point is we know at some point the Federal Reserve is going to lower interest rates. Now, part of the reason why the stock market has done well this year is because that's been pushed out. We think that, initially it was 2024 they were going to lower rates. That may happen and may go longer than that. But the fact is that when the stock market starts to falter and the economy starts to falter, the labor market starts to falter, Federal Reserve is going to lower rates, and that's going to allow those of you that have bonds to have an increase in the bonds. So for the first time in decades, you can buy bonds as a capital appreciation play. So lock in high yields, get capital appreciation. That's the bond market for the younger investors. Other than that, keep going in stocks. For older investors, you want to shift to a higher percentage of bonds because you can't afford to take the risk if you're going to be retiring soon. And if you're already retired and living off your income, please don't be selling shares of your mutual funds and stocks to get your income. Yields are high enough you can live off the incomes without cannibalizing your principal. It's a great time to lock in some income if you're retired.
And what do you think could throw the biggest wrench in that base case in terms of the risks ahead?
Well, the labor market, I think, is a big factor. That's certainly one. And the labor market generally shifts pretty quickly. Right now, the labor market's strong. I still think there's 1.7 or 1.8 workers available for every job. That in historical has been shown to shift very quickly. And the labor market comes before a recession. The weakening of the labor market is going to happen before a recession. That's something that could throw the stock market into a tailspin. The other thing that could throw the stock market into the tailspin is everything that's going on geopolitically. I'm actually surprised that this war hasn't caused a tailspin in the market already. When you look at Israel has, I think they're the fourth largest country, or the country with the fourth largest holdings in the Nasdaq, and that has no small part in the S&P 500 and the Dow Jones. So I'm surprised that the market has been so resilient as it is. But at some point in time, something there could turn as well, especially if we have a terrorist attack on our own country. There's a lot of things out there that could cause the stock market to pop.
Indeed, a lot of us keeping track of all of this. And it's interesting, one of our other guests also talked about perhaps a potential desensitizing of markets to a lot of these things, having sort of been very war-worn down by what we've seen with Russia and Ukraine. Appreciate your insights. Anthony Soccaro, Providence Financial Insurance Services President. Thank you for joining me.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
Investors are shifting focus to big tech earnings this week, with Alphabet, Microsoft, Meta, and Amazon all on tap this week. So what should you be expecting? Well, Yahoo Finance's tech editor Dan Howley has those details for us. A big week here, Dan.
That's right, Michelle. This is a huge week. And the 2 big themes that I think people are going to be looking at are A, the cloud and how AI fits into those kinds of measurements, and B, the digital ads market. So let's start with A, AI and the cloud, because we're going to get Microsoft and Google tomorrow after the bell. The big question here is, how are these big investments that these companies are discussing fitting into their overall revenue when it comes to their cloud performance? So, the AI themselves, the co-pilots that Microsoft has and the AI that Google is offering, those are being fitted into their respective cloud capabilities. And so when you go out and you would purchase something like this for your business, you would be then signing up for an additional cost for access to their AI capabilities. So we're hoping to get some kind of inkling as to how much that's impacting the overall revenue share when it comes to their cloud offerings. And then B, the digital ad market. Now, Google's also a part of that, one of the biggest, and then Meta as well. And we want to get a sense of, where the digital ad market is right now. Is it picking back up? There's some analysts expect it to improve this quarter, the quarter that we're seeing reported. So that would bode well for both Meta and Google, which again is a massive player there, as well as Amazon because of their growing advertising business. The cloud also being a big deal for Amazon as well. We'd like to know more about how their own AI capabilities are extending into the cloud services. But I think it's important to point out that they've been on board with building their own chips and such for some time. So they've kind of been working in this space for a while. So we'll get maybe a bigger call out from them just to kind of show that Amazon is still working on AI, is a big player. And so maybe we'll get some of that there. So I think those are really the 2 major themes we're going to be seeing. You can expect plenty of analysts on these calls to just repeatedly ask what's going on with AI, what's going on with the ad market as well. And then maybe we'll get something from Amazon as far as how its recent sales event went in October, whether it saw an uptake in consumer spending, whether it saw more signups for Prime. So we're going to be looking for that as well.
And Dan, ahead of that, we're seeing this call from a Morgan Stanley analyst about Amazon and Google and the potential for the GPU infrastructure market. What do we know about that so far?
Yeah, they're basically saying here that they could add as much as $50 billion to their revenue by renting out availability of their own NVIDIA GPUs and giving people access to that. Their infrastructure as a service is what it's called, IaaS. And it's not unheard of for companies to do this. They also, by the way, are working on their own chips, Google. They have some already. Amazon has some already. So there's also the possibility they could be renting out those as well for AI capabilities for different companies who need them but can't get access to chips, either because they're just not available and everyone else is buying them up, or because they're simply too expensive for them. So this could be a good alternative for companies that need those capabilities, and it could pay off handsomely for these companies in the long run.
We'll certainly see how much of that we'll hear on the earnings calls this week. Thank you for getting us up to speed, our very own Dan Howley. Well, let's get you a final check of the markets as we head into the noon hour. As we can see here, things have turned positive, but ever so slightly here. The Dow currently up about 15 points. The S&P 500 up about 1/3%. They're driven up by communications at the moment. Energy, the lagging sector so far this morning. The tech-heavy Nasdaq, though, continuing to see some gains, up about 0.5% on the day, about 70 points, as we await that busy week of tech earnings that we'll be breaking down for you right here on Yahoo Finance. Well, that does it for now. I'm Rochelle Akufo. I'll be back with you at 11 a.m. Eastern tomorrow. I'll see you then.